We are moving on to the next chapter for discussion, that is segment 9, input tax credit. In input tax credit also very good number of amendments are there, and there are possibility of asking questions on this also. In this total we have section 41, 49, then 16 to section 21. So these are all the various sections that we have. First we need to talk about availment of ITC, and then utilization of ITC, condition for availment of ITC, apportionment of credit, blocked credit, then availment of ITC and reversal of ITC in special cases, job work provisions and input service distributor. These are the areas. First look into availment of ITC in GSTR 3B. So first, what is input tax credit? GST paid on inward supplies is known as input tax credit, that can be availed as ITC in GSTR 3B and utilized for payment of liability on our outward supplies. So how we will avail ITC in GSTR 3B? So rule 36 sub rule 4, section 41 read with rule 36 sub rule 4 says we can avail the ITC only matched ITC. What is matched ITC? That ITC which is reflected in the GSTR 2B. So that is called as matched ITC. How it will be reflected in 2B? Based on the GSTR 1 of the supplier. So in this regard we need to know few returns. GSTR 1, that is containing the details of output supply filed by every registered person. GSTR 2A, so based on the GSTR 1 of the supplier, so in 2A the inward supply details will be made available based on GSTR 1 or IFF, invoice furnishing facility. A person who is under QRMP is required to file quarterly return, but if they file GSTR 1 quarterly, their recipients also will take ITC on a quarterly basis. For that purpose they can file monthly IFF, invoice furnishing facility, so that the recipient can avail the ITC based on that. So therefore 2A will get the details of inward supplies based on the outward supplies of the supplier in GSTR 1 and IFF furnished by every supplier. Recipient can generate a statement of inward supply in 2A, and this 2A is auto populated from GSTR 1 filed by the suppliers. And GSTR 2B is a static document that is also containing the inward supply details. Both 2A and 2B contain the same details, but 2A will get updated very frequently, which means it is like a dynamic document, but 2B is a static document. If the GSTR 1 is filed by the cutoff date, so then only the details will be reflected in 2B. So GSTR 2A is just for reference purpose, but 2B is for the purpose of availment of ITC. So 2B is a static month-wise auto-drafted statement for regular taxpayers. It is like 2A, but it remains static. GSTR 3B is actually the return in which we will be reporting our details of tax and ITC, and we will be paying the tax also at the time of filing this return. At the time when we file GSTR 1, the tax payment shall not arise, but at the time of filing 3B, the tax payment shall arise. What is the difference between 2A and 2B? So type of document, 2A is dynamic and 2B is static. TDS, TCS details will be reflected only in 2A but not reflected in 2B. Details of invoices if GSTR 1 filed after due date. If GSTR 1 filed after due date also, 2A gets updated automatically, but 2B will not get. It will be reflected in next month 2B. However, it is reflected in subsequent 2B. And what is the purpose of 2A? It is just for reference, and 2B is for the purpose of availment of ITC. As per rule 36 sub rule 4, only that ITC which is reflected in 2B can be taken. So supplier will file the outward supplies in GSTR 1 based on the GSTR 1 of the supplier. If it is filed by the due date, the data is reflected in 2B of the recipient, and this data or ITC is known as matched ITC. This should be taken as the base. So avail ITC in 3B. So ITC in 3B will be self-assessed ITC. How that self-assessed ITC will come? First we will take ITC as per GSTR 2B, and there are three things which should be eliminated, even though it is reflected in 2B, but it should be eliminated. So what are they? Blocked ITC. There are some ineligible ITCs that then used for non-business purpose or used for exempted supplies, because the portal don't know whether it is a blocked ITC or it is used for non-business purpose or it is used for exempted supply. For that reason they will be giving it to you in 2B, but you should not be taking it, even though it is reflected in 2B, but it is ineligible, we should not take. Whereas there are three ITCs which will not be reflected in 2B, right? They are not reflected in 2B but eligible, not reflected in 2B but eligible. What are those three things not reflected in 2B but eligible? That is GST paid under RCM. Whatever GST we have paid under RCM, then re-availment of ITC reversed earlier, ITC not availed in earlier periods but reflected in 2B of that period. Okay, so which is like whenever I pay GST under RCM, my supplier will not report in GSTR1. As my supplier not reporting in GSTR1, it will not come in my 2B, even though it is not coming in my 2B, but GST paid under RCM can be availed as ITC. But definitely we will get an error message in the portal that we are taking the ITC in excess. At that time we will get a notice in terms of rule 88D, but we need to reply to the notice accordingly that this is the GST paid under RCM, which we can take as ITC. Then next, re-availment of ITC reversed earlier. That is, first we have availed the ITC, and because of certain contraventions we are reversing the ITC. Again, upon fulfillment we can re-avail the ITC, but when we re-avail the ITC, so this will not be coming in this month to be, it's okay, but even we can take. There are two cases where we will reverse and re-avail. Situation number 1, if the recipient is not making payment to supplier within 180 days from the date of invoice, so much of the ITC availed by recipient needs to be reversed, and again as and when recipient makes payment to supplier, the recipient can re-avail the ITC, and this re-availment need not be there in 2B, but they can take this, and this is given in rule 37. Then rule 37A is there, that is whenever the supplier has not filed GSTR 3B by September 30th of the next financial year, then whatever ITC already availed by recipient needs to be reversed, and again as and when supplier files GSTR 3B at a later point of time, the recipient can re-avail the ITC. Again it will not be in 2B, but it can be taken as ITC. Then next one is about the ITC pertaining to a particular month, not availed in that month, but we are availing now. Because we have not availed at the time, maybe we are of the opinion that we are not eligible for ITC, but now we are availing the ITC, or there may be other reasons like we can avail ITC only when the goods and services are actually received based on invoice, we may not avail the ITC, but it came in 2B of the earlier month, not availed in that month, and now we are availing. Can we take that? Yes, we can definitely take that, but it may not come in this month 2B. So these are the three things. Even though it is not reflected in this month 2B, we can avail the ITC. This is known as self-assessed ITC. And next one we have rule 37A. This is what I was referring to. Section 41 read with rule 37A. So far what we have seen is section 41 availment of ITC read with rule 36 sub rule 4. Therefore, how much ITC we can avail in GSTR 3B? Availment of ITC means taking credit in GSTR 3B. For that we have taken ITC as per 2B, and we will make the adjustments, and that is called as ITC availed in GSTR 3B. Got it? Now we are discussing as to what will happen if the supplier has not filed 3B. If the supplier has not filed 3B, so that is given in section 41 read with rule 37A. So look into this chart. Supplier reports the invoice in GSTR1, and that invoice is filed, that return is filed within the time limit. As soon as the supplier files GSTR1, automatically it will come into the recipient's ITC. It will be reflected in 2B of the recipient, and whenever it reflected in the 2B of the recipient, what recipient will do? He will avail the ITC in his GSTR 3B. Thereafter, supplier is not filing 3B by September 30th of the succeeding financial year. He filed 1, but he did not file 3B. As he did not file 3B by September 30th of next financial year, so therefore the recipient should reverse the ITC. How will recipient know that the supplier has not filed GSTR 3B by September 30th? So that data will be made available to the recipient in his GSTR 2B. In his GSTR 2B, whose GSTR 2B? Recipient GSTR 2B, there will be 3 columns. ITC available, ITC not available, ITC reversal, like that. In that ITC reversal, when they see, they will identify as to who are all the suppliers who has not filed the GSTR 3B by September 30th. That data will be available, which means the recipient should open this GSTR 2B when? So after September 30th for the previous year. For example, previous year 24-25. For previous year 24-25, after September 30, 2025, when they open the 2B, they will be able to see ITC reversal. In that ITC reversal, who are all those suppliers who did not file 3B by September 30th, that data will be reflected here. That amount he need to reverse. By when he need to reverse? He need to reverse it by November 30th. Means he has only 2 months time. And if he is reversing it by November 30th, no issue. If he is not reversing by November 30th, then he need to pay interest. Interest at the rate of 18% per annum. From which date to which date? From the date of utilization of ITC till the date of reversal. You can see here. So if the supplier not filed 3B by September 30th of next financial year, the recipient should reverse the ITC after September 30th of next financial year, but before November 30th of next financial year. And what if the 3B is filed after September 30th? Then again he can re-avail the ITC. ITC reversed earlier can be re-availed without any time limit. Remember, generally there is a time limit for availment of ITC, that is 30th November of succeeding financial year or date of filing and written, whichever is earlier. But in case of re-availment of ITC reversed earlier, so we don't have any time limit. Even beyond that also we can re-avail this ITC. And here, suppose if the recipient is not reversing the ITC by November 30th, what will happen? They need to pay interest. So interest at 18% shall be payable from the date of utilization till the actual date of reversal or payment. Then what is the manner of utilization of credit? So far what we saw is availment of ITC. Now we are looking into utilization of ITC. First we have taken the ITC, but there are some restrictions with respect to utilization. So principle number 1 says that IGST credit, there is no restriction, means IGST credit can be utilized for payment of any GST liability. Same way any GST credit can be utilized for payment of IGST liability. But with respect to other three, that is CGST, SGST and UTGST, there is a restriction of cross utilization, which means CGST credit only for CGST, if not IGST. So then SGST for SGST, UTGST for UTGST. But compensation cess has got one special point, that it cannot be adjusted with IGST also. Compensation cess can be utilized only for payment of compensation cess. That is with respect to this principle number 1. And principle number 2, with respect to the priority, that is I have IGST credit. IGST credit for what purpose I should use? I can use it for any purpose, but first it should be utilized for payment of IGST liability, and thereafter between CGST, SGST, UTGST in any manner, any proportion depending upon its liability you divide. For example, here you can see, say I have some gross liability, so of CGST, SGST, IGST, I have a gross liability of say 5,000, 5,000 and 5,000, and I have an ITC of 2,000, 2,000 and 10,000. So now I have excess credit of IGST. Now which credit I need to exhaust first? Always remember, there is one principle number 3 which says that before utilizing CGST and SGST credit, the credit of IGST should be completely exhausted. So therefore this IGST credit I need to exhaust completely. So therefore what will I do? First I will be taking my gross liability. So the gross liability will be 5,000. Okay, gross liability will be 5,000. So CGST, SGST, IGST. So my gross liability I will take. So gross GST payable. Gross GST payable. What is that gross GST payable? 5,000, 5,000, 5,000. Which credit I need to utilize first? Minus IGST credit. What is that IGST credit that I have? 10,000. But first I should use it for payment of 5,000, because the principle number 2 talks about the priority. IGST credit first for IGST payable. So 5,000 I have utilized. Still I have 5,000. That 5,000 don't utilize for CGST fully or SGST fully, because you observe what is their liability. So this small computation you need to make. What is their liability? 5 minus 2, 5 minus 2. That is 3,000, 3,000. Equal liability na. So you equally split. So that is like 2,500 and 2,500. And thereafter you will be utilizing CGST and SGST credit. CGST and SGST credit we have utilized. That will be 2,000 and 2,000. So that we will get net GST payable. So net GST payable will be 500, 500, 0. So the total will be like 1,000. So now whenever you do this computation in exam, kindly put the total column also, because what happens, there will be multiple answers possible. When multiple answers are possible, they may not award the marks if it is not matching with the key, because not all educated people are evaluating. Okay, uneducated, illiterate buffoons are evaluating. They will not read properly. Okay, they see whatever is there in the key, for the sake of some 200 rupees and all, they will pledge our career. Got it? So for that reason, so please put one more total column, and in this total column, so that if you are writing that 1000 rupees, maybe they will see, so somewhere it is similar to the key, they have written something like that, at least they will consider. Okay, so one total column, don't forget to add in exam, because there are multiple answers which is possible. We don't know the person who is giving the key will take what assumption, we don't know, because the problem with this exam is that the one who is setting the question paper is not setting the key, and the one who is setting the key is not doing the correction. So therefore they will create question paper in one way, these people will give the answer key in another way, and thereafter evaluator will get the key and he will do the evaluation. So God only knows. In the top of this, there is a discussion that why can't we use artificial intelligence for evaluating. Ayyo, super. And we don't know what will happen. Okay, so better clear before that all these things comes. So therefore, that is this. So we can utilize it. And how to know whether our answer is correct or not? 5000, 5000, 5000, total is 15,000. 2000, 2000, 10,000, 14,000. So 15 minus 14,000, 1000. So 1000 should be our net liability. If you are able to achieve that, then your answer is correct. That is with respect to this. And so therefore IGST credit should be first utilized for payment of IGST, then for CGST, SGST, UTGST. CGST credit first for CGST, SGST first for SGST, UTGST first for UTGST. If you have any balance, that will be utilized for payment of IGST. Principle number 3, we should exhaust IGST completely before utilizing CGST, SGST credit. Last principle is I have all the credits but only one liability, that is IGST liability. Which credit I need to use first? I need to use IGST credit, and thereafter CGST credit, and thereafter SGST or UTGST credit. So IGST credit after utilizing for payment of IGST liability can be used for payment of CGST, SGST in any manner, any proportion. So multiple answers are possible. My view is that depending upon the CGST, SGST liability, it should be apportioned. And GST compensations can be utilized for payment of GST compensations only. So therefore, whenever in your outward supply you have GST compensations, then only you can take credit of GST compensations on inward supply. So in exam they will give some inward supplies with GST compensations. Now you need to analyze the outward supplies, whether in anywhere in the outward supplies there is GST compensations, then only you take the credit of GST compensations on inward supply. Is it clear? And for example, I am a dealer of car. When I am a dealer of car, when I am selling the car, I will be charging GST compensation cess. When I am purchasing the car from manufacturer, he will also charge me GST compensation cess. Can I take that as credit? Of course I can take as credit, because in my outward supply also GST compensation cess is there. Whereas I am into the business of renting of motor vehicles. When I am into renting of motor vehicles, on renting there is no compensation cess. So therefore, whenever I am purchasing car, on the GST compensation cess is there. Even though for a person who is into business of renting a motor vehicle, they can take ITC on motor vehicle, but GST compensation cess cannot be taken. Reason being, in their outward supply there is no GST compensation cess as liability. Then next one, section 16. Section 16 talks about conditions for availment of ITC. In that there are total 8 conditions. Condition number 1, only a registered person can avail ITC. Of course, unregistered person cannot avail ITC. Condition number 2, the inward supply should be used or intended to be used in the course or furtherance of business. Used means used for existing business. Intended means something which we are going to use in future, but we purchase it now. We can take ITC. It is not like depreciation section 32, put to use only we can claim depreciation, not like that. Here, even though you have not used, we can take the ITC, full ITC we can take. So used or intended to be used in the course or furtherance of business. Furtherance means some business which we are going to start in future. Then number 3, that is recipient should be in possession of tax paid document. What is a tax paid document? Either tax invoice or debit note or ISD invoice, input service distributor invoice, which will be given by the head office, which takes ISD registration and distribute the credit to the branch offices. So that ISD invoice, then bill of entry. At the time of import we will file bill of entry and we will pay customs duty along with IGST. That to take that IGST as credit, we need to be in possession of bill of entry. So that is this condition number 3. Recipient should be in possession of tax paid document. First two are the basic condition. Only registered person can avail ITC. Inward supply should be used or intended to be used in the course or furtherance of business. Next three conditions to be fulfilled by the recipient. So what are those three conditions? Number 1, he should be in possession of tax paid document and he should have actually received the goods or services. So if the invoice is pertaining to January but the goods are received in March, he can take ITC only in March, he cannot take ITC in January. Same way services, even though there is GST on advances, but can they take ITC with respect to services? No, only when the services are actually received they will be able to take ITC. Then another condition is that to take the ITC they need to file GSTR 3B. There is no other way in which they can take ITC, only by filing 3B they will be able to take ITC. So these are the three conditions, point number 3 and point number 4 and then point number 7. So recipient should have actually received the goods or services, recipient should have filed the returns, that is GSTR 3B. Next three conditions is not in the capacity of the recipient but it is to be fulfilled by the supplier. What the supplier should do, he should be reporting those details in GSTR 1 and that GSTR 1 should be filed by the due date. So what will happen if the supplier is not at all filing GSTR 1? It will not come in 2B. If it is not coming in 2B, cannot be taken. Number 2, if supplier files GSTR 1 but he missed the invoice, will it come in 2B? No, it will not come in 2B. So ITC cannot be taken. He reported the details in GSTR 1 but he reported wrong details in GSTR 1. Then also that amount will not come in 2B. Consequently, it cannot be taken as ITC. That is the reason why there will be a mismatch between whatever ITC that is there in records versus whatever ITC that is reflected in GSTR 2B. That is this point. So supplier should have furnished the details in GSTR 1 and those details which are reported by supplier in GSTR 1 should not be restricted in GSTR 2B, means it should not come under ITC not available. Why the hell it will come under ITC not available? Because of section 38. This section 38 is a contravention which is done by the supplier, because of which in GSTR 2B, as I told you, in GSTR 2B there are three columns: ITC available, ITC not available and ITC reversal. So it should come in ITC available column, then only we will be able to take ITC. If it is in ITC not available, means supplier filed GSTR 1 but he made some contraventions, because of which it is coming in ITC not available. So we will not be able to take ITC. What are those contraventions? That is given in section 38. As per section 38, in few cases ITC shall be restricted in 2B. What are those few cases? You can see in section 38, which is in returns chapter. So just turn some pages, you will be able to find this information in returns, that is page number 150. Page number 150. So you give the page number reference here. If you want, in the following cases, even though supplier declare the details of outward supplies in GSTR 1, ITC can be restricted in GSTR 2B as per section 38. What are those cases? Supplier is a newly registered person. So supplier is newly registered person. So whenever you are buying from that newly registered person, even though he has filed GSTR 1, but it will be coming in your 2B under ITC not available. And thereafter, whenever he regularizes his return, it will be going to ITC available. So this is actually a temporary exercise. Means right now it is under ITC not available, but at a later point of time it will be moved to ITC available. So supplier is a newly registered person. So therefore it comes in your ITC not available. Number 2, supplier has filed GSTR 1 but not filed GSTR 3B for some earlier periods, because in past and all, so without filing GSTR 3B of the previous month, we can file the GSTR 1 of this month, but that provision that without filing 3B of the earlier month you cannot file GSTR 1 of this month came now only. So but in the past it was not. So in the past what they have done, they have filed lot of GSTR 1s but they have not filed GSTR 3B. Now they are filing GSTR 1. Even though they file GSTR 1, we will not be able to take ITC. It will come under ITC not available because they have not filed 3B for the earlier months. Okay, then next one, supplier liability in GSTR 1 is greater than liability in 3B, means, 1 second. Okay, listen. So what has happened is that supplier has filed GSTR1 and he also filed GSTR3B. If the supplier has filed GSTR1 and if he has not filed 3B, which is already covered there in the second point, but if he filed both, GSTR1 also he filed, GSTR3B also he filed, but what happened is that the liability in GSTR1 is greater than the liability in GSTR3B. So even though he filed GSTR1, but we will not be able to take ITC because it will be coming under ITC not available. And fourth point, supplier has availed ITC in his 3B, which is more than the ITC as per his 2B, means he has taken more ITC in 3B. Then when you are buying from such a person, so even though he filed GSTR1, but you will not be able to take ITC because it comes in our ITC not available. Then supplier has defaulted in payment of taxes, means there is some demand and recovery and there is some notices or order which is passed against that supplier, and even though he filed GSTR1 for this month, but we will not be able to take ITC because there is demand notices and he defaulted in payment of tax and the default continues. And there is one provision called as Rule 86B, which says that every person whose taxable turnover exceeds 50 lakhs in a particular month should pay 1% of their liability through electronic cash ledger. If that supplier has not fulfilled that point of payment of 1% of liability through cash ledger, now from such supplier you have made a purchase, you will not be able to take ITC. So these are the 6 situations where even though your supplier has reported details in GSTR1, but you will not be able to take ITC. So what are those first points? Like first 6 cases. So supplier is a newly registered person, supplier GSTR1 filed but 3B not filed, supplier liability in 1 greater than 3B, supplier ITC in 3B greater than 2B, supplier default in payment of tax and the default continues, and supplier has not paid 1% of liability through cash ledger. These 6 cases, it will come under ITC not available. Can we take ITC? No, we cannot take ITC. What is the recourse mechanism? So initially itself, you should have got the KYS, know your supplier. You understood how they will be getting know your customer. You should be getting know your supplier. So you should have asked the supplier, are you fresh? Yes, sir. Then I will not buy from you. Means newly registered persons. And like that you should have asked them and then only you should have purchased from them. So therefore you purchase. What is the recourse mechanism? Now after it is coming in ITC not available in 2B, so you will call that supplier and you will ask, boss, what is it? It is coming in 2B, are not available, so do something. So for which supplier will rectify these mistakes, any of these mistakes, but which mistake we also don't know, he also don't know, got it? But he need to rectify that mistake. Based on that, it will be going into ITC available and we will be able to take ITC. You got it? So it is like our hair in their hands. What if hair is not there, sir, like you? No problem. So that is this. And coming back to this, so whenever the supplier files GSTR1 and he reports it in GSTR1, but the problem is that it will be restricted in 2B. GST paid on inward supply should not be reflected in 2B under ITC available and should not be restricted. So then third condition in the hands of supplier is that he should have paid the tax. But when he should have paid the tax? By September 30th of the succeeding financial year. Only then we can take ITC. No, first itself we can take ITC. But if he is not paying tax by September 30th of next financial year, we need to reverse the ITC. Supplier should have paid tax with respect to such supply within September 30th of next financial year. Then these are the 8 conditions to be satisfied. In these all 8 conditions, except 6th condition, all other 7 conditions should be fulfilled at the time of availing ITC, but this 6th condition alone should be fulfilled later point of time. Okay, so this condition not to be checked at the time of availing ITC, not to be checked at the time of availing ITC. So not to be checked at the time of availing ITC. Got it? So therefore that is only the special point here, but in all other 7 cases the condition needs to be checked at the time of availing ITC. Then input tax means what? So tax paid under FCM or tax paid under RCM. Even whatever GST we paid under RCM, can we avail it as ITC? Of course, yes. In the same month, can we avail as ITC? Yes. So default in the same month we can take as ITC. If the question has any other information, then we need to go by that information. Otherwise, this month we are paying GST under RCM means this month itself we can take ITC, because now they have brought in one very important amendment. In case of RCM, you can take ITC only as and when you give invoice to your supplier. So previously and all, this provision was not there. Previously, as and when we pay GST under RCM, in that month itself we can avail the ITC. But now they have brought in invoice. Invoice means what? Whenever you gave invoice to your supplier, in case of RCM, supplier is unregistered, recipient is registered, the recipient should give self invoice to the supplier within 30 days from the date of receipt of goods or services. So whenever the recipient gives invoice, then only recipient can take ITC. So this point may be tested. That's what I told you. Check for the question. If the question is silent, you take the month in which the tax is paid. In that month itself, you can avail the ITC under RCM. So input tax means CGST, SGST or UTGST charged on supply of goods or service or both made to a registered person. It also includes tax paid under reverse charge basis and IGST charged on import of goods. Even IGST paid on import of goods also can be taken as credit, but it does not include tax paid under composition scheme. First of all, a person who is opting for composition scheme should not charge GST. Even if they are charging GST to us, we should not be taking ITC. That is this point. Then we should be in possession of tax paid document. What is a tax paid document? Tax invoice. Whether all the tax invoice details should be there in that tax invoice, then only we can take ITC. No. So any document which has some minimum details, then it will be considered as a tax invoice for availment of ITC. What are those minimum details? GSTN of supplier, GSTN of recipient should be there. Then in like value should be there, tax should be there, and description also should be there. Finally, place of supply should be there. So to know whether it is intrastate supply or interstate supply, date is mandatory. Apart from date, these are the minimum details that should be present. Description of goods or services, value, tax, GST of supplier and recipient, and place of supply in case of interstate supply. Then it will be called as a valid document for availing the ITC. HSN details not there, it's okay, we can take ITC. SAC details not there, it's okay, we can take ITC. Now, what if the supplier has not given e-invoice? Instead of giving an e-invoice, he gave a normal invoice. Can we take ITC? No, we cannot take ITC with respect to that. That point I connected in e-invoice. Even though the supplier has given invoice, he reported the details in GSTR1, but we cannot take ITC because he has not given e-invoice. He gave a normal invoice. Got it? Next, what are the inward supplies means? Inward supplies means capital goods, inputs and input services. Capital goods means any goods which are purchased and capitalized in the books of the person is known as capital goods. Inputs means other than capital goods, that is which are charged to P&L will come under inputs. Input services means any services received will be coming under input services, but all these should be used or intended to be used in the course or furtherance of business. Okay, then deemed delivery. So this is like generally when the goods are received or the service are received, then only ITC can be availed. But in case of bill to ship to transaction, what will happen? I am delivering the goods to my billing address or shipping address. Shipping address means a third person, but I am raising invoice to my billing address. So billing address cannot take ITC because they have invoice but they have not received the goods. Same way shipping address cannot take ITC because I have received the goods but the invoice is not in their name. So which means literally both cannot take ITC. For that reason they have created this deeming fiction, which means that the date on which the shipping address has received the goods or services, it is deemed that the billing address also has received the goods or services. Consequently, the billing address can take ITC. So in bill to ship to transactions, who will take ITC? Billing address will take ITC. Even though they have not received the goods, it is deemed that they have received the goods on the date on which shipping address has received. And service also it will be applicable. For example, I am raising invoice to your chartered accountant, but I have provided lectures to you. In that case, can your chartered accountant can take ITC? Yes, because the date on which you received the services on behalf of your chartered accountant, so that is CA firm, then the date on which you received services, CA firm has received the services, so CA firm can definitely take ITC under this deemed delivery concept. But only thing, you should be in the articleship, means it should be in the course or furtherance of business. For the CA firm, then only the CA firm can take ITC. That is this: when goods are delivered to any person or service are provided to any person on the instructions of the recipient, the date on which such person has received goods or services, it is deemed that the recipient has received the goods or service and they can take ITC. That is, in case of bill to ship to transactions, billing address can take ITC. Then there is one query here. Sir, in case of import of goods, it is not notified under 9(3). So therefore, should we take it under RCM? That's what I told you. So previously and all, ICI used to take the situation that import of goods on which IGST paid, they were not taking under RCM liability, but of late in some other questions they have added that is IGST paid on import of goods as a part of the RCM liability. So therefore I told you right now, so you need to follow that. So whatever IGST that we pay on import of goods, you take it as a part of RCM, but because of that your answer will not get affected, because whatever IGST you paid under RCM, that you will take as ITC and you will adjust it against your FCM liability, but anyhow that RCM you need to pay, and therefore that is not going to affect your answer, but the total etc and all may change. But trust me, ICAI has taken the same view in the recent questions also. In RTP also they have given that, so happily you take that IGST paid on import, you take as your RCM liability. Then next, goods received in lots or installments. Say for example, you placed an order for 100 units and 40 units got delivered in first month, 30 units in second month and 30 units in the third month. Then when can you take ITC? So proportionately can we take ITC? No, only on receipt of last lot we can take ITC, provided all these things are with respect to an invoice. What if separate invoices are given? When separate invoices are given, accordingly we can take ITC. So please write down, ITC shall be availed only on receipt of last lot or installments with respect to an invoice. This provision is applicable only for one invoice if they are delivering in multiple lots. Okay. Then reversal of ITC, this is rule 37. When the payment is not made to supplier within 180 days from the date of invoice, so much of the ITC available by recipient needs to be reversed. Now say for example, you have made the payment of 60% within 180 days and 40% you have not made within 180 days, then how much you need to reverse? Only proportionate to 40%. And suppose if you have not at all paid 100% within 180 days, so you need to reverse the ITC. Again, thereafter you paid 30% to the supplier. How much you can re-avail as ITC? That 30% can be re-availed as ITC. So the proportionate calculation we need to check. What if the contract says that the credit period is more than 180 days? Even then this 180 days will be applicable? Yes, this 180 days only will be applicable. So the contract should not be seen in this case. So that is about this. If recipient has not made payment to supplier within 180 days from the date of invoice, then so much of the ITC proportionate to the amount not paid to supplier availed by the recipient shall be reversed along with interest at 18% per annum. From which date to which date? From the date of utilization. What is the date of utilization? That month in which the balance in ITC falls below the wrongly availed ITC. To that extent, ITC is utilized till the date of reversal. However, if the availed ITC is not at all utilized, which means to this extent every month there is a balance. Should we pay any interest? No, interest payment shall not arise. Interest not payable if the availed ITC is not utilized. And there are three cases where this particular 180 days condition is not applicable. What is that? Supply without consideration. There is no consideration at all, wherefrom recipient can make payment to supplier within 180 days. So therefore this is not applicable. Then the liability is on the recipient. When recipient is required to pay GST under RCM, so therefore payment to supplier is not at all a condition here. Due to that reason, again 180 days is not applicable. Then 3, payment already made by the recipient to some other person on behalf of the supplier. For example, you are making payment to a creditor on behalf of me. In value of supply we discussed. You made payment to my creditor on my behalf. In that case, so definitely that is my indirect consideration, 15(2)(b). It should be included in the value. So whether I should receive it? No, already my creditor has received it. On my behalf, some other person has received it. So again, don't apply 180 days condition. Payment to third party on behalf of supplier, 15(2)(b). These are the three cases where this above proviso will not be applicable. Again, ITC can be re-availed as and when payment is made to supplier after 180 days, but the interest paid cannot be re-availed as ITC. Interest paid is gone. That is a complete loss. And if you don't want to pay interest, you maintain that sufficient balance in the ITC. There is no time limit for this re-availment. Then next section 16 subsection 3, that is while computing the depreciation under section 32 block of assets method, when we add the asset, we should not add the asset along with the GST component. For example, we purchase capital goods for 10 lakhs and GST will be 1,20,000. So in the block of assets, how much should be taken? 11,20,000 or 10 lakhs? 10 lakhs. If you take 10 lakhs, then 1,20,000 you can take ITC. If you take 11,20,000, then ITC is not available. So this similar point is there in 32 also, which says that if you avail ITC, you should not add 11,20,000 in the block like that. So if depreciation is computed on 11,20,000, then ITC of 1,20,000 is not available. Then time limit for availment of ITC, the time limit is 30th November of succeeding financial year or date of filing annual return, whichever is earlier, but this time limit is not applicable in case of reavailment of ITC reversed earlier. Now, in case of debit note, which date should be taken for the purpose of deciding the time limit, whether the invoice date should be taken or the debit note date should be taken? Definitely debit note date only should be taken. So even though the invoice is given for the debit note some 4 years before also, but see the debit note date, sir, there is no time limit for debit note. Of course yes, for credit note only there is a time limit. So because credit note leads to reduction in liability, so there is a time limit. So because it's a loss to government, whereas debit note leads to increase in liability, gain to government, why they will give time limit? Yeah, after 100 years also you give debit note, no issue. So therefore some debit note is given now for 10 years before invoice. In that case, based on debit note only we need to see for availment of ITC, not the invoice date. So in case of debit note, availment of ITC depends on the debit note date but not on the date on which invoice related to such debit note is given. Then this is the point I was referring to. In case of RCM, where registered recipient issues invoice to unregistered supplier. Remember, self invoice concept is there, that's an amendment now. Previously also it was there, but previously there was no clarity as to what is the time limit within which the self invoice needs to be given. Now they have amended section 31 subsection 3 clause F accordingly with the rules, and they are telling that in case of self invoice, first of all, when self invoice, if the supplier is unregistered and the recipient is registered, then the concept is known as self invoice, and the recipient should make payment to the supplier and recipient should pay GST under RCM, but he need to give invoice also. Now what is the time limit within which invoice to be given? 30 days for goods or service or anything. Whenever supplier is unregistered and the recipient is registered and the service or supply of goods is covered under RCM, the recipient should give invoice to the supplier within 30 days from the date of receipt of goods or services, and based on that the recipient can avail the ITC also. But to avail the ITC, what should be taken as the relevant date for the purpose of availment of ITC? So for that reason they gave a clarification. In case of RCM, where the registered recipient issues invoice to unregistered supplier, generally who will give invoice to whom? Supplier to recipient, but here supplier is unregistered and the recipient is registered. The date on which recipient issues invoice is relevant for determining the time limit for availment of ITC, but not the date on which the supply is made, etc. and all. So now this is the amendment, so which you need to keep in mind. So related to this, I have given one question. So generally, lot of students were asking me, literally torturing me, sir, amendments like that. But the problem with amendments is that I cannot take separately amendments. If you observe, everything is interconnected. If I take also, I cannot justify as to, amendment. See, I can take for the sake of use, for the sake of convincing my students, I can take, but it should be fruitful, na? End of the day it should be fruitful. That's the reason why I asked them, wait pa, I will take rocket revision. Sorry if I have made you wait, because now you will understand the importance, because I am connecting many places. This is very much required in CA final exam, that's why. Fine. So look into this question on amendment related to this RCM provision. I think it is question number 1 second. Question number 15. Question number 15. Infosys Limited this we discussed yesterday. I think in this I told you, correct, in this itself I told you when they can take ITC like that. In this itself I told you, that is in case of RCM, yesterday itself we completed this discussion. In case of RCM, the invoice needs to be given within 30 days, okay, within 30 days from the date of receipt of services. So when can they take ITC? So whenever they issued the invoice to the supplier, they can take ITC with respect to that, okay. So that is this, but somewhere etc. I discussed it. So when we see the other questions, it will come there. I'll explain, no issue. So that is about this RCM case. Then the time limit for availment of ITC for certain financial years. So these two sections were newly added by Finance Act 2024, and this will be applicable so immediately itself. So time limit for availment of ITC for certain financial years. This is like a small provision for a stopgap arrangement. So 2017-18 to 2020-21. From financial year 2017-18 to 2021, if ITC is availed beyond the time limit, what happened at that time, 17-18 to 2021, there was a huge dispute about the time limit for availment of ITC, because at that time it was 30th September of the succeeding financial year for which return was required to be filed. Return means GSTR 3B was the assumption, but GSTR 3B was not at all considered as a return at that time. At that time return was only GSTR 3, which was not notified. So due to that reason, so many people were having a doubt about availment of ITC. Even they are not required to file annual return time limit also got extended from time to time, and for that reason they took the ITC even beyond the time limit. So at that time, which year, 17-18 to 2021, when they took the ITC beyond the time limit, all those ITCs were rejected. So because it was beyond the time limit, so this was rejected. These people went to the appeal, and when they went to the appeal, the many writ petitions were filed. Finally, so what happened, the case went to Supreme Court also, and Supreme Court said no, definitely ITC should be given to them. Thereafter, what GST, finance minister did, GST department, they asked the GST department to give the benefit, whatever refunds that, whatever ITCs that you have rejected, now you give the ITC back to them. But for which financial years? 17-18 to 2021. But by what time they should have availed the ITC? Okay, they availed the ITC beyond the time limit, but maximum by what time limit they should have availed the ITC? November 30, 2021. So they should have availed the ITC by November 30, 2021, which got rejected, and now we will be giving them the benefit. It is allowed even though it is in violation of section 16 subsection 4. Got it? And so which means it is for that past period, now they are giving the benefit. Then same way, section 16 subsection 6 also they have given time limit for availment of ITC in case of revocation of cancellation of registration. So what is the time limit for availment of ITC? So see this first, say this, that is, registered person can claim ITC on such invoice or debit notes in any written file within regular time limit or 30 days from revocation order, whichever is later. Let me give you the background of this. Initially what has happened, so time limit for availment of ITC was regular time limit 30th November, date of filing return, etc., whichever is earlier. Now what happened, my registration got cancelled. When my registration got cancelled, so I cannot file the return. As I cannot file the return, I could not take the ITC, but I was eligible to take ITC before the date of cancellation of registration. I had some inward supplies. I can take the ITC, but I missed to take ITC, and now I want to take, but I cannot take because my registration is cancelled. So I made an application for revocation and say 3 months window. After 3 months, they have revoked my cancellation. So they have given a revocation order. Now in these 3 months, I could not take ITC and the time limit got expired. Say for example, September 1st they have given the cancellation order, and I have made the revocation application and they have given the revocation order on December 31st. But in this September to December I cannot file return, but November 30 over, that is the time limit for availment of ITC got expired. Now in that case I could not take ITC. Okay, now what they are telling, it's okay even if that November 30th got expired, but they have added one more point. What is that one more point? What is the date on which I got the revocation order? 30th December or 31st December I got the revocation order. Na? From there within 30 days also I can avail the ITC. That is this 30 days from the date of revocation order, whichever is later. Whichever is later. This is another place where we have whichever is later provision, that is the time limit by which I can avail the ITC. Is it applicable for past periods also? Yes. For past periods also, where we could not take ITC because of the time limit, now they are giving. Sir, what is the time limit, sir, by which I need to make this application for taking these 2 credits? Again I am repeating, please concentrate. Section 16.5 and section 16.6. These 2 are applicable for past periods also. And it is not only for the current period. Actually 16.6 is for the current period as well as past period, whereas 16.5 is only for the past period. And how to take these 2 ITCs, for that they have given one procedure. So that procedure you can see in the next chart. registered person to whom ITC is available under 16.4 or 16.5, they made an application by 7/4/2025. They should make by 7/4 till time limit is there. Even now also you can tell to your CA firms and to the clients that 7/4/2025 still time limit is there for making application. So we are in what? Just March only. 7th April they have given the time. So we can still take the ITC. So an application should be made, and moreover this is not online form, this is offline form only, and to our jurisdictional officer who has rejected our ITC claim, to that person only we need to make application. Officer who passed the order of disallowance of ITC, if satisfied within 3 months, they will pass a rectified order and we can enjoy the ITC. Otherwise, suppose if they are not satisfied, if they are of the opinion that no, we should not get, even we are not covered under these two sections, then they will reject the application. Rejection of application after giving opportunity of being heard. Now you don't have to remember this application date, but remember this process of 3 months. Within 3 months, if satisfied, they will give, otherwise they will reject. And this is about section 16.5 and section 16.6. Related to this section 16.6, I gave one question, so please have a look into that question. It is there. That is related to revocation of cancellation. Yes. TechPro, question number 17. TechPro Solutions Private Limited, a registered person under GST, had its registration cancelled by the proper officer on June 1, 2024 under section 29 of CGST Act. Yes, section 29 of CGST Act deals with cancellation of registration due to non-compliance with filing of returns. The company has received the input services for which it was eligible for ITC during the financial year 23-24. For financial year 23-24, what is the time limit for availment of ITC? 30th November 2024 or date of filing annual return, whichever is earlier. As the question is silent about date of filing annual return, usually when the question is silent about date of filing annual return, you take the due date of filing annual return itself as the date of filing annual return. What is the due date of filing annual return? 31st December 2024, whichever is earlier, that is 30th November 2024 is the time limit for availment of ITC for this financial year. Got it? But from June 1st, what has happened? 30th November 2024 is the time limit. From June 1st, what has happened? See the question. From June 1st, our registration got cancelled. Okay. Then, so therefore, on August 25, 2024, TechPro Solution applied for revocation of the cancellation of its registration under section 30 of CGST Act. The registration was revoked by the proper officer on September 5, 2024, allowing TechPro to continue its business operations. However, during the period of cancellation, TechPro Solutions received several invoices and debit notes for supplies made between June 1, 2024 and August 25, 2024. This is the facts of the case. Now, the company is now considering the possibility of claiming ITC on invoices pertaining to the supplies made during the period June 1st to August 25, 2024. That is the period of cancellation. For this, the regular provision only, no issue. What is a regular provision? What is the financial year for which this invoices pertains to? Not 23-24, 24-25. For 24-25, anyhow we have a time limit for availment of ITC, that is 30th November 2025 or date of filing annual return, whichever is earlier, that is 30th November 2025 time limit is there. Happily we can take ITC with respect to that by the time limit, correct or not? That is the answer. Time limit for availment of ITC in respect of invoices for the period 1st June 2024 and 25th August 2024, that is the period of cancellation of registration, that is invoices pertains to financial year 24-25, A 30th November or B date of filing annual return, assume that it is 31st December 2025. So the time limit for availment of ITC will be what? Whichever is earlier. Which is earlier? 30th November 2025. Is it clear? Understood here? This is for which period? This is for the period June 1st 2024 to August 25 2024, that is the period of cancellation of registration. For this they have not given any amendment. This is normal, this is there, even before also it is there, now also it is there. But second point, you see, debit notes issued during the financial year 23-24 but not availed before the date of cancellation of registration. For 23-24 we should have availed the ITC at the time, but we missed. When we missed, we have a time limit by which we could have taken, but what happened? Cancellation of registration came, so we could not take. Now can we take? For that only they have brought in amendment A, the regular time limit. What is the regular time limit? 30th November 2024 or date of filing and return, whichever is earlier, that is 30th November 2024. B, 30 days from the date of revocation order. What is the revocation order? September 5, 2024 plus 30 days, that is October 5, 2024, whichever is later is 30th November 2024 only. So the regular time limit is only later. So 30th November 2024 only will be taken. Is it clear here? So the regular time limit or the 30 days from revocation order, whichever is later, that is 30th November 2024. Now suppose if this question is modified and in that they are asking what if revocation order is passed on 15/12/2024, then what would have happened? Then in that case the regular time limit is 30th November 2024 or the date of filing and return, whichever is earlier, is 30th November 2024, or 30 days from revocation order. The revocation order will be 15/12/2024 plus 30 days, that is 14/1/2025, whichever is later. So 14/1/2025 is the time limit by which they can avail ITC. Understood here? So like this they can definitely make a question on this time limit connected with cancellation of registration because of the amendment. Then look into the next one, apportionment of credit. Apportionment of credit and blocked credits. In this apportionment of credit, what happens is that when you are purchasing some inward supplies which is used purely for taxable and business purpose, can we take ITC? Of course we can take ITC. If the inward supplies are used for exclusively exempted supplies or non-business purpose, can we take ITC? No, we should not take ITC. When inward supplies are partly used for taxable, partly used for exempted, yes, proportionate ITC we can take. Same way when inward supplies are used partly for business and partly for non-business, then also we can proportionately take ITC. That is this. These two cases we can take proportionate ITC. And how do we take proportionate ITC? Don't take the ITC directly. So there is rule 42 and 43, and everywhere it is clearly given that first we need to follow ITC availed minus ITC reverse, then only we will get the net eligible ITC. This is the format we need to follow. For example, common ITC. The common ITC is somewhere 1,50,000 and the taxable turnover and exempted turnover is given. The taxable turnover is say somewhere like 40 lakhs and exempted turnover is 20 lakhs. Taxable turnover 40 lakhs, exempted turnover is 20 lakhs. Then in that case we will be taking the ITC. So how we will take the ITC? First ITC avail. ITC avail. What is the ITC avail? Full ITC you take, 1,50,000 you take, minus ITC reverse. What is ITC reverse? Proportionate to exempted. That is 1,50,000 into exempted turnover 20 divided by total turnover 60. This needs to be reversed. Okay. So 1,50,000 into 20 divided by 60, that will be 50,000. So when you reduce 1,50,000 minus 50,000, 1 lakh will be taken as the net eligible ITC. So this is the format you need to follow. Directly also 1,50,000 into 40 by 60 we can take, but that should not be followed. This is the format in which you need to avail the ITC. So ITC avail minus ITC reverse, net eligible ITC. So that is only given here. Proportionate ITC. And what about zero rated supplies? Zero rated supplies will be treated as taxable supplies for the purpose of availment of ITC. That's the reason why when a product is exempted or a service is exempted, the moment it is exported, it will become zero rated and we can happily enjoy the ITC on our inward supplies. That is this. Then section 17 subsection 3 deals with meaning of exempted supplies. So there are certain transactions, even though it is not a supply, even though it is taxable supply, but we are treating it as exempted supply. This meaning of exempted supply is only for the purpose of ITC chapter, because generally the meaning of exempted supply, so meaning of exempted supplies we have in two places. One, general throughout the GST law, that is given in section 2. So usually whenever a definition is given in section 2 of an act, that will be applicable throughout the act. Whereas whenever a definition is not given in section 2 but it is given in some other place, then which means it will be applicable only in that particular chapter. So for that purpose, so like that, meaning of exempted supply which is given in section 2 is applicable throughout the GST law. What is the meaning of exempted supply? 3. Notified as exempted, nil rated, non-taxable. Government from time to time will be giving certain notifications for exemption, that is notified as exempted. Nil rated means the rate of GST is nil. Non-taxable, that is alcoholic liquor for human consumption and petroleum products. These three are treated as exempted for payment of GST. But for ITC purpose, we have same three we have: notified as exempted, nil rated, non-taxable. In addition to that, there are 4 transactions which are not at all supply but treated as exempted supply. What are they? Concentrate, sale of land, sale of building. When sale of building, where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. And then sale of securities. Securities are neither goods nor services, but it will be treated as exempted for the purpose of ITC. Then supply of warehoused goods under customs. Sale of warehoused goods under customs. In this regard, they have added one point, that is, there is a duty-free shop. Duty-free shop which is in the international airport. Duty-free shop in international airport is treated like a warehouse, customs warehouse only. Now that particular duty-free shop, when they are selling to incoming passengers goods, then it will be treated as sale of warehoused goods under customs, because that incoming passenger who is purchasing from a duty free shop need to pay baggage duty, because as if these goods are imported from outside India to India, they need to pay baggage duty. Anyhow they are paying baggage duty. So for this duty free shop, when they are making sale to the incoming passengers, it will be treated as not a supply, excluded from supply. You got it? So when it is excluded from supply, even though it is excluded from supply, but it is treated as exempted supply. What if the duty free shop makes sale to outgoing passengers? Then that is treated as export. So it will be treated as zero rated supply. As it is zero rated supply, they can enjoy the ITC. So connecting these 2 points, I have given one chart below. You can see this. There is a duty free shop in international airport, and that duty free shop in international airport is making sale to incoming passengers as well as sale to outgoing passengers. Sale to outgoing passengers is treated as zero rated supply. And in that case, can they take ITC? Of course, yes. Can they get refund of ITC? Yes, they will get refund of ITC. Whereas they are making sale to incoming passengers, which is supply or not a supply, it is not treated as supply. It is treated as sale of warehouse goods under customs. Even though it is not supply, it is treated as exempted supply for reversal of ITC. And this duty free shop to sell, they may be purchasing some goods locally. So purchases by them within India chargeable to GST, and they can avail the ITC. Now that much of ITC attributable to zero rated supplies, they will get the refund, whereas that much of ITC attributable to the sale to incoming passengers is treated as exempted and they need to reverse the ITC. That is the meaning of this. What it? So sale of, so 4 transactions, these are the 4 transactions, 5, 6, 7, 8. Sale of land, sale of building, sale of securities, supply of warehoused goods. So these 4, even though not a supply but treated as exempted supply. For land, what should be taken? Stamp duty value. Building, what will be taken? Same stamp duty value. Securities, we will take 1% of sale value of securities. In case of the sale of warehoused goods, whatever is the price at which they are selling, that only will be taken. Then first 3 notified as exempted, nil rated, non-taxable. Next these 4. Then one more point, that is supply covered under RCM. When my outward supply is covered under RCM, it is taxable, not in my hands, my recipient hands, but for me it will be treated as exempted and I cannot take ITC on my inward supplies. That is this supply covered under RCM. Supplier of RCM supplies cannot take any ITC, but recipient can take ITC with respect to whatever GST they pay under RCM. So these are the 8 transactions which are treated as exempted for the purpose of ITC, computation of ITC. But in this also, there are two exceptional points you need to remember. That is, there are two transactions which are exempted, but it will be treated as taxable for ITC purpose. Number one, interest on loans, advances, deposits. So this is actually exempted for payment of GST, but while computing ITC, it should be treated as taxable. So thereby your ITC reversal gets reduced. But to whom they need to give this benefit, to whom it will be more? Interest on loans, advances, deposits, banks, financial institutions, NBFCs, correct? But for them this provision is not applicable, got it? So to whom they have to give, they did not give. Interest on loans, advances, deposits will be treated as exempted for payment of GST, but for ITC purpose it will be treated as taxable. But for other than banks, financial institutions, NBFCs, which means for banks, financial institutions, NBFCs, it is treated as exempted both for payment of GST as well as for ITC purpose. Same way. Number two, sale of duty credit scrips. The sale of duty credit scrips in customs. So duty credit ledger, we get a e-scrip. That e-scrip can be transferred to any other person. This is actually exempted. So sale of duty credit scrips is exempted. It's a supply, but it is exempted. Even though it is exempted for payment of GST, but for ITC purpose it will be treated as taxable. So consequently we can enjoy the ITC. That's what they are trying to convey. So first 8 points you need to remember. Then these two transactions, even though it will be exempted, but it will be treated as taxable. Then apart from that, one more point already we know, zero rated supplies. Zero rated supplies, even though the burden becomes zero, but it will be treated as taxable for the purpose of availment of ITC. Next, we have rule 42, that is manner of availment of ITC with respect to inputs and input services. But this rule 42, simple, we will see later, but I wanted to give you one question related to this, discussion of meaning of exempted supplies. So you can take that in comprehensive questions. Let's do one question so that you will get an idea. So in the solved workbook, it is there in question number question number 10, page number 614. So we have some comprehensive questions. I have given for 14 marks question types how they can give. So you can see one question out of that which is connected to this meaning of exempted supply. Question number 10. Adityanath Private Limited is registered person under GST in the state of Uttar Pradesh. It is engaged in supplying three products, product alpha, product beta and product gamma from its factory located in Rampur, Uttar Pradesh. Product alpha and product beta are taxable, whereas product gamma is exempt from GST. Besides, it also supplies cigarettes from its factory located in Kanpur and owns a petrol pump in Lucknow. It is also engaged in supply of certain services. It has furnished the following information with regard to supplies made by it in the month of August. So they have given lot of outward supply details. So what you need to do is that whenever you get a question like this, so even in IBS also follow the same strategy. So what is it you need to do? First you need to read some initial paragraph. After reading initial paragraph, you will come to know that what business they are doing, etc. and all. Then you need to go to the last. When you go to the last, you will know what is the requirement that you need to do in that question. So see there, with the help of above mentioned information, compute the gross GST payable of Adityanath Private Limited for the month of August on the outward supplies made by it during the said period, gross liability. Now, you add one more point here, compute net liability, okay. Even though the question is about gross liability, let's modify the question. So compute net liability, write down, compute net liability if common inputs is rupees 75 lakhs and common input service is rupees 25 lakhs excluding applicable GST. Let's add this part and do the recomputation of this question. So we need to compute net liability. When we need to compute net liability, what is it we need to take? First we need to take gross GST under FCM, and thereafter any RCM liability and even ITC, everything we need to do in this case, okay. And they have also given some rates. Assume the rates of GST on outward supply of goods and services is 12% and 18% respectively unless otherwise specified. Ignore CGST, SGST and IGST for the sake of simplicity. Exports made by Adityanath Private Limited, if any, have been made to persons other than distinct persons and are made by furnishing LUT without payment of IGST. That is, generally whenever they have given only exports, but the question is silent. So then we need to take any option. So my recommendation is that go for export without payment of IGST. But in question definitely they will clearly give which option they are going for. So here they are going for furnishing LUT without payment of IGST. Fine. Now we need to compute net GST payable. For that we have lot of outward supply data. So always we need to prepare one working note when you have lot of outward supply data. One for payment of GST what it is, and for computation of ITC what it is, because we have some sale of land, sale of building, etc. and all. So we need to prepare a working note like this. Okay. So what is that working note? So before proceeding to this question, before commencing the answer for this question, we need to prepare this working note, so it will become easy for us. So we are preparing a working note. In this working note we will see particulars, that is what is the transaction about, and then we will take what is the value, and then for payment of GST, that is little bigger column because we need to compute GST liability, and thereafter one last column for availment of ITC, So in this value column is useful for the purpose of computing the exempted turnover, total turnover details, etc. and all. And for payment of GST is useful for the purpose of computing our gross GST payable. So everything we can put it in one working note so that it will become easy for us while doing the answer. Now, so first we need to start with transaction number 1. Transaction number 1 is supply of product alpha. Product alpha is 50 lakhs. They have not given anything that this product alpha is exempted. Clearly they mention gamma is only exempt from GST, but alpha and beta are taxable. So supply of product alpha taxable. So 50 lakhs. And what is the rate of GST applicable to goods? For rate of GST for goods is 12%, service is 18%. So therefore we need to take 50 lakhs into 12%. So supply of alpha, that is value 50 lakhs. And for payment of GST it is what? Taxable. And as it is taxable for payment of GST, definitely it will be taxable even for ITC purpose. So whatever special points we discussed is 10 points. Apart from the 10 points, any other transaction, if it is taxable for payment of GST, it will be taxable for ITC also. Okay. And so as it is taxable, we need to compute the GST liability 50 lakhs into 12%, that will come to 6 lakhs. 6 lakhs is the liability. Then next transaction, supply of product gamma. So supply of gamma, and gamma is actually what? Exempted, correct? So clearly it is given in the question itself, gamma is exempted. So 1 crore is exempted, but whether we will take it in the amount column? Yes, we need to take in the amount column. So it is exempted for payment of GST. When it is exempted, we don't have any liability. So when it is exempt for payment of GST, it is covered anywhere in the special points? No. So means it will be exempted even for the purpose of computation of ITC. Then next transaction is supply of management consultancy services 50 lakhs. They have not given anything. Nothing is given means it will be taxable. So what is the rate of GST? 18%. So management consultancy services. Management consultancy, how much? 50 lakhs. And what is it? Taxable. As it will be taxable for payment of GST, we need to take GST, how much? 50 lakhs into 18%, that will be 9 lakhs. As it is taxable for payment of GST, definitely it will be taxable even for ITC purpose. Next one, renting of commercial complex to local traders of electronic goods. So basically remember, whenever we are giving commercial property on rent, there is one amendment now. In case of renting of commercial property, if the supplier is unregistered and if the recipient is registered, it will be covered under RCM. But here the supplier is registered, so RCM will not come, it will be FCM. So Adityanath Private Limited is registered under GST. So renting of commercial complex is a service, that is 30 lakhs. Renting of complex, that is 30 lakhs, and it will be taxable. We don't have any exemption with respect to renting of commercial property, and 30 lakhs into 18%, that will be 5,40,000, as it is taxable for payment of GST, definitely it will be taxable even for ITC purpose also. Export of product beta. Product beta is taxable and it is exported. So they are going for which option? Without payment of IGST, wherever possible without payment of IGST. So therefore, export of beta. So export of beta, what is the value that is given there? Export of beta will be, so 1 crore, and 1 crore it will be what? Zero rated and under bond or LUT. So there is no GST in this case. Even though there is no GST, it will be treated as taxable for the purpose of ITC, computation of ITC. So because it comes under those 10 special points. Next one, renting is 50 lakhs only. Okay, I took 30 lakhs, sorry. Renting is 50 lakhs, then it will be taxable, so 9 lakhs will be taken. Then next one, can you help me? Export of consultancy services, including exports made to Nepal based company of rupees 5 lakhs. Payment is received in Indian currency in the said case. So generally, export of services is for a consideration in convertible foreign exchange, but wherever it is permitted by RBI, it can be in Indian rupees. Where is it permitted by RBI? Two cases it is permitted by RBI: services to Nepal and Bhutan, and payment received in rupee Ostro account. When the payment is created in rupee Ostro account, which is maintained by a bank outside India, even then the payment is received in convertible foreign exchange. Here Nepal, it is export of services, and in this case, whether it will be under bond or LUT? Yes, LUT. So again there is no GST, same. Export of services 20 lakhs. Export of services 20 lakhs, and it will be what? Zero rated. Whether we need to pay GST or not required to pay GST, not required to pay GST, but for ITC purpose it will be treated as taxable. And next one, sale of building excluding stamp duty of 2,50,000 being 2% of the value adopted for paying stamp duty. Entire consideration is received post issuance of completion certificate. So which means it is not a supply, but it will be treated as exempted supply for ITC purpose. How much should be taken as the value? In case of sale of building, we need to take stamp duty value. What is the stamp duty value here? 2 crore 50 lakhs is not stamp duty value. 2,50,000 is 2%. So which means 100% is how much? 2,50,000 is stamp duty. So means we need stamp duty value. So therefore 2,50,000 divided by 0.02, that will be 1 crore 25 lakhs will be taken as the sale of building. Sale of building, we need to take 1 crore 25 lakhs as the value, and it is not a supply. As it is not a supply, payment of GST shall not arise, but for ITC purpose it will be treated as exempted. Then next one, interest received on investment in fixed deposits in money bank. Interest on FD is exempted, but for ITC purpose it will be treated as taxable because they are not bank financial institution, other than bank financial institution NBFC. So interest on fixed deposits. Interest on deposits. What is the value of interest on deposits? 10 lakhs. 10,50,000. It is exempted. It is exempted for payment of GST, so liability is not there. But for ITC purpose, it will be treated as taxable. And next one, sale of shares of a public company. Purchase price of that share is 2 crore 40 lakhs. So 2 crore 50 lakhs is the sale price. So sale of shares is actually not a supply, but it will be treated as exempted. Sale of shares, not a supply. What is the value of sale of shares? 1% of sale value. Don't take full amount, take only 1% of sale value. So 2 crore 50 lakhs into 1%. So 2 crore 50 lakhs into 1% will be 2,50,000. But for ITC purpose, it will be treated as exempted. Then next one, supply of cigarettes, GST being levied at 28%, including excise duty of 12,50,000. So 1 crore. Supply of cigarettes is taxable for payment of GST. Even for ITC purpose also, it will be treated as taxable. So supply of cigarettes, what is the value? Supply of cigarettes will be 1 crore. And what is it? It is taxable for payment of GST. So goods or services are goods. Goods means 1 crore into 12% will be 12 lakhs. 12 lakhs. But for ITC purpose, as it is taxable for payment of GST, even it will be treated as taxable. But you made a mistake. It should not be 1 crore. Because while computing the ITC, so old indirect taxes should not be taken into turnover. Okay, there are 4 old indirect taxes that should not be taken into turnover while computing the ITC. So this point I have given here. So you can see this. Page number 106 of your pocket book, that's it book, you can see that is while computing turnover under rule 42, 43 and section 20. Rule 42 is applicable in case of reversal of ITC on inputs and input services. 43 is in case of capital goods, and section 20 is input service distributor. Old indirect taxes. What are the old indirect taxes? Central excise duty, state excise duty, then central sales tax and value added tax. That should be excluded. It should not be taken into account. But actually it is contradiction with section 15(2)(a). Section 15(2)(a) says all taxes, duties and cess by whatever name call other than GST should be included in the value. Okay. So this is actually exception to section 15(2)(a). This is exception to section 15(2)(a). Section 15(2)(a) says all taxes, duties and cess by whatever name call other than GST should be included in the value. Means consequently this old indirect tax also should be included in the value. But we should not be taking this for the purpose of ITC computation, which means while computing GST you should include it or not? Yes. But while computing ITC it should be excluded. Right now we are taking the amount column. So in the amount column you need to take out how much is the value of this excise duty? 12,50,000. So 12,50,000 you take out from 1 crore, so that will come to 87,50,000. But you need to compute the GST on 1 crore only. Because for computation of GST it should be included. So 1 crore into 12%, that will be 12 lakhs. Okay. For computation of GST it should be included. For ITC purpose only it should not be included. So that is about supply of cigarettes. Then next one what we have is supply of petrol and diesel. Petrol and diesel are non-taxable supplies. So we don't have to pay GST. But again here also same, they have given including VAT and excise duty. So what should be taken as the value? Do that and tell me. Sale of petrol and diesel. Actually it is exempted. We don't have to treat it as taxable because it is non-taxable, and then we need to take value as how much? 80 lakhs minus VAT and excise duty will not come. While computing the turnover for ITC purpose, VAT and excise duty will not come. So minus 5 lakhs minus 12,50,000, that will come to 62,50,000. So 62,50,000 will be taken as the value. Okay. Next one we have amount received from Durgadas Private Limited of Lucknow. It has sponsored the business exhibition organized in Delhi by Adityanath Private Limited. Basically, in case of sponsorship services, if the recipient is body corporate or firm, it will be covered under RCM. So it's a sponsorship service. For sponsorship service only one exemption is there, that is if the sponsorship is with respect to recognized sporting event. Here it is not a recognized sporting event. Due to that reason this sponsorship service will be taxable, and as the recipient is body corporate, it will be covered under RCM. Means it will not be taxable in the hands of Adityanath Private Limited. So even though it is taxable under RCM, but for ITC purpose it will be treated as exempted. Okay. So sponsorship services. What is the value of sponsorship services? 6 lakhs. Sponsorship service is 6 lakhs and it is actually taxable under RCM. Means don't add it to this person's liability, but for ITC purpose it will be treated as exempted. Okay, and so in case of cigarettes, rate of GST is 28%, sir, but why you have taken 12%? Because the rate is given in the question as 12%, that's why we are taking 12%. And we don't know, really I don't know what is the rate applicable to cigarettes also. So this guy, you know, in the question it is given. So but see this note, assume the rates of GST on outward supply of goods and services are 12% and 18% respectively, unless otherwise specified. So is it specified? Yes. GST being levied at 28%. So 12%, 18%, but unless otherwise specified. Here it is specified as 28%. Due to that reason we are taking 28%. So one mistake we did. What is that? We have taken 12%. So it should have been into 28%. So that will come to 28 lakhs. 28 lakhs. Next one, anything else in the outward supply? No. Amount received from Durgadas Private Limited of Lucknow, that's it. Now we completed this working note. So far what we complete is only working note. We have not completed the answer. Now we need to write the answer. What is that? First, statement number 1. Computation of GST payable on outward supplies. Computation of gross GST payable on outward supplies. Computation of gross GST payable on outward supplies. What is that gross GST payable on outward supplies? Here already we did the computation. Just take that 6 lakhs plus 9 lakhs plus 9 lakhs plus 28 lakhs. So how much? 6 lakhs plus 9 lakhs plus 9 lakhs plus 28 lakhs. That will come to 52 lakhs. So 52 lakhs already we did the computation. That is the help of working note. So once you prepare the working note, this step will become easy. Okay. Is there any inward supply under RCM? Nothing. There is no inward supply under RCM. GST payable on inward supply. GST payable on inward supply under RCM is statement 2. That is 0. That is 0. We don't have anything in this question. Then third statement, computation of ITZ availed and reversed. Computation of ITZ availed and reversed. So for this, first we need to know, for ITZ purpose, for ITZ reversal, what is the taxable turnover, exempted turnover and total turnover? Tell me. Taxable turnover, already you see the working note. Exempted turnover, and then total turnover. Taxable turnover, exempted turnover and total turnover. What is taken as taxable turnover? So wherever it is given as taxable, you take those amounts. So that's the reason why we prepared a value column. Wherever it is taxable, that is 50 lakhs we will take, and then again next to 50 lakhs we will take. Thereafter next 50 lakhs we will take. So 1 crore 50 lakhs, then next 1 crore, then 20 lakhs. Thereafter we have 10 lakh 50,000, then 87 lakh 50,000. Next, that's it na. So that 3 crore 68 lakhs is taxable turnover. Then exempted turnover we need to get. What is that exempted turnover? 1 crore. Then next one is 1 crore 25 lakhs. Thereafter 2 lakh 50,000. Then 62 lakh 50,000 plus 6 lakhs. That will come to 22 crore 96 lakhs. 2 crore 96 lakhs plus 3 crore 68 lakhs will come to 6 crores 64 lakhs is the total turnover. Now IT is availed. That is given in the question. So that's what we have added. 75 lakhs and 25 lakhs. So 75 lakhs into goods. So into 12%. Okay. So 75 lakhs into 12%. What is it? 75 lakhs into 12%. Into 12%, that will be 9 lakhs. Then input services. Input services is how much? 25 lakhs into 25 lakhs into 18%. That will be 2 lakh, 4 lakh, 50,000. So this is ITZ avail 9 lakhs plus 4 lakh 50,000, that is 13 lakh 50,000 minus ITZ reversed. ITZ reversed. What is the ITZ reversed? 13 lakh 50,000 into, because everything is common, exempted by total. What is exempted? 296 divided by 664. So 13 lakh 50,000 into 296 by 664, that will come to 6 lakh 1,807. We need to reverse. So this is called as the net eligible ITZ. Net eligible ITZ for set off. So will be 7 lakh 48,193. Now liability we got 52 lakhs. So last statement, computation of net GST payable. Computation of net GST payable. What is the taxable turnover? What is the taxable turnover? Exclude, wait. Excluding zero rated. Excluding zero rated, because for rule 86B, we need to check, we need to check taxable turnover excluding zero rated. So we need to take only taxable. Zero rated should not be counted, exempted should not be counted, non-taxable should not be counted. Okay, only taxable, purely taxable excluding zero rated. If you see, so first one 50 lakhs, then 50, 1.5, and zero rated should not be taken. Okay, zero rated should not be taken. So definitely it is more than 50 lakhs, correct? More than 50 lakhs. More than 50 lakhs means rule 86B is applicable. But the problem here is, anyhow they have to pay more liability, because if you see their gross liability 52 lakhs, 52 lakhs into 1%, 52,000. But if you see their credit, just 7 lakh 48,000. Anyhow, naturally they will pay net liability more than that. So that's why no need to apply rule 86B here. Got it? This is one step which we need to follow. So gross GST payable. So what is the gross GST payable? Gross GST payable here will be 52 lakhs. 52 lakhs minus what is the ITZ utilized? ITZ utilized will be 7,48,193. When you adjust that, you will get net GST payable. So what is that net GST payable? 52 lakhs minus 7,48,193, that is 44,51,807. Okay. So hope you understood as to how we need to arrive at the answer in case when we have a question like this. Okay. So I am expecting a question of this sort, because it's quite a long time they have not asked, because last time if you see, mostly the question was on place of supply. Last time 14 marks question, most focus is on place of supply, and like that one attempt 14 marks question will be given on one focused area. Like that input tax credit related focused area also many times, many attempts the questions came. So this time also I am expecting a focus area of input tax credit. So this question, this type of question can be asked, because it has a meaning of exempted, reversal of ITZ, even one circular also related to old indirect taxes. Okay, so they can test a question like this. Okay, we'll continue with the discussion. So far we have seen apportionment of ITZ. Now we need to move on to rule 42. Rule 42 deals with manner of availment and availment and utilization of ITZ in case of inputs and input services. In case of capital goods, it will be rule 43. So for inputs, what we need to do is that first we need to see what is the total GST paid on all inputs. That total GST paid on all inputs will be denoted with T1, and this T1, T, and this T you can make note there itself just some numbers in order to know as to what is the process in which we are doing. First we need to see in the question whatever is the inward supplies on which GST is paid, whatever inward supplies on which GST is paid will be denoted with T. That will be, say for example, 10 lakhs is the T. that is total tax paid on inward supplies. This 10 lakhs we need to segregate into 4 T1, T2, T3, T4. T1 refers to inward supplies used for non-business purpose. Say we have some 1,50,000 rupees of inward supplies used for non-business purpose, and inward supply used for exempted outward supply, say 2 lakhs, and then blocked ITC is 50,000. Now with these three we need to take out. So total 10 lakhs is the tax paid on inward supply minus inward supply is for non-business purpose 1,50,000 minus exempted supply is 2 lakhs minus 50,000 T3. Now what you get balance is 6 lakhs. That 6 lakhs is known as ITC availed in GSTR 3B. So this is the ITC that will be availed in 3B. Thereafter we need to separate inward supply used for taxable and business purpose. Say inward supply used for taxable and business purpose is 4 lakhs. So minus 4 lakhs. What is the remainder that is left? 2 lakhs. That 2 lakhs is known as common credit. So T refers to total tax paid on inward supplies, and T1 non-business purpose, T2 exempted supply, T3 blocked credits, and if you reduce T1, T2, T3, you will get ITC availed in 3B 6 lakhs, and thereafter inward supply exclusively for taxable and business purpose. If you separate, you will get common credit. Common credit means partly used for business, partly used for non-business, partly used for taxable, and partly used for exempted. So this common credit you need to check how much is attributable to exempted supplies. So for that we need to take exempted turnover. Say exempted turnover is somewhere like 40 lakhs and total turnover is somewhere like 60 lakhs. Then what we need to do? So out of this 2 lakhs proportionate to exempted. What is proportionate to exempted? 4 by 6. So 2 lakhs into 4 divided by 6, that will be 1,33,333 needs to be reversed, and thereafter out of this common credit there is one invoice. Out of this common credit there is one invoice which is partly for business, partly for non-business. Then the entire common credit into 5% we need to reverse. So therefore entire common credit is 2 lakhs. 2 lakhs into 5%, that will be 10,000. 2 lakhs into 5%, that is 10,000. But remember, out of this common credit there should be at least one invoice which is partly used for business, partly used for non-business. Suppose if you know exactly how much is used for business and non-business, say 1/3 is used for non-business, means 1/3 we will keep in T1 itself. So 1/3 is used for non-business, like that if you know, you segregate it in T1 stage. So therefore 2/3 will not be coming here, 2/3 will come in T4, or it may come in common also, but this 5% point is not required. This 5% point is required only if out of the common credit there is one invoice or one inward supply which is partly used for business and partly used for non-business purpose. Then we need to do this reversal. So what is the ITC availed in GSTR 3B? ITC availed in GSTR 3B is 6 lakhs in this example. 6 lakhs is the ITC availed in 3B. And what is the ITC to be reversed? So to be reversed is 1,33,333 and 10,000 rupees. That is 1,43,333 is the ITC to be reversed. And what is the net eligible ITC? So C1, that is ITC availed in 3B minus D1 and D2, 1,43,333, that will be 4,56,667 will be taken as the net eligible ITC for set off. Okay, so 4,56,667, and this particular computation above shall be computed separately for ITC of CGST, SGST, UTGST and IGST, and D1 and D2 will be computed again at the end of the year. Whatever we are doing, this D1 and D2 is only for month on month basis. Again we need to do this computation at the end of the year. When we do this computation at the end of the year, so what will happen? Whatever we have already reversed is provisional. Say for example that is some 5 lakhs, and what we need to reverse at the end of the year, that is D1 and D2, again we need to recompute. So because of the ratio it may change, and we may be having to reverse 5,50,000. What we have reversed is 5 lakhs. What we need to reverse is 5,50,000. So that 50,000 rupees we need to reverse along with interest at the rate of 18% per annum from the 1st April of succeeding financial year till the date of payment. What if we have already reversed is 5 lakhs? What we are supposed to reverse is only 4 lakhs, means we have excess reverse. That excess reverse 1 lakh can be availed as ITC. So that is, if the amount is less than amount added to output tax liability every month, the additional amount paid has to be claimed back as credit in the return of any month till September of the succeeding financial year. Usual time limit is November, but in this case it will be September only we can avail the ITC. That is, by September we need to avail the ITC. This is about rule 42. So in case of rule 42, please keep in mind that you need to just stick on to the format. So this format, if you do, you will know C1, that is ITC availed in 3B, D1 and D2 is ITC reverse. So that balance is the net eligible ITC. Then rule 43. Rule 43 is manner of availment of ITC with respect to capital goods. I am purchasing some capital goods which is exclusively used for taxable supply or business purpose. Can I take ITC with respect to this capital goods? Yes. I am purchasing some capital goods which is used for exempted or non-business purpose. I cannot take ITC with respect to this capital goods. If I am buying some capital goods which is partly used for taxable and partly used for exempted, I can take ITC, but full ITC I cannot enjoy. Over a period of 60 months, I need to reverse the ITC. So therefore, I need to take monthly ITC. So see the treatment in case of capital goods too. So first you avail the 100% ITC with respect to GST paid, and that you will transfer it to electronic credit ledger. Thereafter you need to compute monthly ITC. What is a monthly ITC? Total ITC divided by 60. You will get monthly ITC. So here the life of the capital goods is assumed to be 60 months. Can we take a period less than 60 months also? Yes. In the question, suppose if they have given 36 months or 48 months, you go by that 36 months or 48 months. If the question is silent, then only you need to take 60 months. So if the question is 60 months, you take 60. If the question is silent also, you take 60 months. So ITC availed divided by 60. For example, we are purchasing capital goods for 10 lakhs. On that capital goods, 1,80,000 is the GST. So 1,80,000 divided by 60, 3,000 rupees will be taken as monthly ITC. That monthly ITC, we need to see what is the exempted turnover of that month divided by total turnover of that month. For the next 60 months from the rate of purchase, compute monthly ITC attributable to exempted supply. How to compute monthly ITC attributable to exempted supply? Monthly ITC into exempted supply for that month divided by total supply for that month we need to take. This above amount to be added to output tax liability for every month for the next 60 months along with interest. But in this case, the interest will be computed at the rate of 18% per annum from the date of availment of ITC till the date of addition to output tax liability is paid. And what will happen if this particular capital goods within the 6 months is sold, within the 60 months it is sold? Whenever the capital goods are sold, always 18 subsection 6 will come into picture. What does 18 subsection 6 says? So much of the ITC availed minus 5% for every quarter or part thereof from the date of purchase till the date of disposal, or GST payable on sale value of such capital goods, whichever is higher. So the above procedure is not required from the month in which the capital goods are sold, as GST is payable as per 18(6). Then say this, initial purchase you are using for CG1 means what? Initially I purchased some capital goods. Say for example, on 1/4/2023 I purchased some capital goods, and this capital goods purchased is used for CG used for taxable. CG used for taxable. Okay. So on 1/4/2023 we purchased capital goods and it is fully used for taxable. What is considered as the life of the capital goods? The life of the capital goods will be taken as 60 months or 5 years. Means the life of the capital goods is up to 31st March 2028. That is 60 months. And at a later point of time, say after 2 years, from 1/4/2025, we started using it for both taxable and exempted. CG used for both taxable and exempted. Now tell me what is the treatment to be followed. Again I am repeating. First, initially we purchased capital goods and we have used it only for taxable. At a later point of time, say on 1/4/2025, it is used for both taxable and exempted, which means for what period it is used only for taxable? 2 years, and for 3 years it is used for both taxable and exempted. So 3 years or 36 months. Now at the time of purchase of capital goods itself, ITC availed or ITC not availed? ITC availed. So now don't take the ITC because ITC already availed. Just recognize it as common ITC. Just recognize it as common ITC from 1/4/2025. Thereafter, for next 36 months, 3 years or 36 months, what you need to do for the next 36 months? You need to do the monthly reversal. So monthly ITC. So that is how to calculate monthly ITC. Say for example, we purchase this capital goods for 10 lakhs excluding GST at 12%. Excluding GST at 12%. So that will be coming to 1,20,000. So 1,20,000 into exempted turnover divided by total turnover of that month. So 1,20,000 divided by 60 or divided by 36. Divided by 60 only should be taken, not divided by 36. Why not divided by 36 should not be taken? Even though we are going to reverse it for 36 months, but the life of the capital goods will not change. The life of the capital goods will be same. So 1,20,000 divided by 60 into exempted turnover of that month divided by total turnover of that month. So that particular month, for that month we need to reverse. Is it clear? So this we need to reverse for a period of 36 months along with interest. At what rate? 18%. From which date? From 1/4/2025, not from the date of availment, because the date of conversion will be taken as the date of availment here. So therefore from 1/4/2025 the interest computation shall arise. This is in case when initially the capital goods are purchased and used for CG1, at a later point of time used for CG2. ITC already availed at the time of purchase, so no need to avail common credit. Monthly ITC equals to original ITC divided by 60. Proportionate reversal from the month of conversion for balance useful life. And for computation of interest, consider ITC availment as the date of conversion. So whenever it got converted, that is taken as the date of availment of ITC. This is about the first situation. Then another special case, that is initial purchase, you are using it for CG3, that is same story, but what happened is that initially I have purchased and I have availed ITC, initially purchased and I used it for exempted, okay. Initially I purchased and used it for exempted. Now when I have used it for exempted, whether I would have availed ITC, I have not availed ITC, definitely ITC is not availed, ITC not availed. Now can we avail the ITC? Say after 2 years, CG is used for both taxable and exempted. Can we avail the ITC? Yes. So avail the ITC, ITC availed. How much is the ITC availed now? So how much to be taken? 1,20,000. Full ITC you take. Full ITC you take. But for the last 2 years, it is used for what purpose? For the last 2 years, it is used for exempted. So for that purpose, you need to do the reversal. This is past reversal. What is the past reversal? The past reversal will be 5% for every quarter or part thereof from the date of purchase till the date of conversion. So how many quarters? 2 years means 8 quarters. So therefore 1,20,000 into 5% into 8 quarters we need to reverse. So 1,20,000 into 5% into 8 quarters, that will be 48,000. This is past reversal. So right now we will avail the ITC of 1,20,000 and thereafter we need to do the reversal for the past period 48,000, and again future reversal also will arise. What is that future reversal? Same for the next 36 months. For the next 36 months, we need to do the same monthly ITC 1,20,000 divided by 60 into E by F of that month. So which means that, so past reversal also is there and this is future reversal. This is future reversal. Future reversal. Whereas in case of the previous situation, it is only future reversal. There is no past reversal because in the past it is used only for taxable, but here it is used for exempted. So that's the reason why first we will take ITC, past period we will reverse, even future also we will do the reversal for the balance life. That is with respect to this. And so you can see here initial purchase, ITC not available at the time of purchase, so it should be availed now, that is original GST paid. Ineligible ITC, ineligible ITC to be reversed for the period it is used for exempted, GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And here the month-wise quarter means what? That is like depending upon the calendar quarter we need to take, and monthly ITC equals to original ITC divided by 60 months, proportionate reversal from the date of conversion for balance useful life, interest to be computed from the date of conversion. So this is about capital goods, and here there could be some special situations. What is it? Special situations? Initially I purchased and used it for exempted, later on I am using it for taxable, then what should I do? Then in that case, so I need to go for 18 subsection 1 clause D, 18(1)(d). Initially I purchased and my outward supplies was exempted. and at a later point of time my outward supply became taxable, that is covered under 18(1)(d), availment of ITC on closing stock including capital goods. Same way, initially I purchase used for taxable, at a later point of time it is used for exempted, then I need to reverse the ITC on capital goods as per 18 subsection 4. Whereas initially I purchased and used for common, now I am using it for only taxable. Simple, you don't have to do the E by F reversal. Initially I purchased and used for common, now I am using only for exempted. Simple, fully you do the reversal because you are not going to use it for taxable at all. Then here there is one rule 32 sub rule 4 which we discussed in value of supply, which says that for a life insurance business there is a special valuation methodology wherein they will not pay GST on entire premium. In case of single premium annuity policy, they will pay GST only on 10% of the single premium. In case of reinvestment policy, premium collected minus amount allocated for investment will be taken as a value. Whereas in case of any other policy, first year premium into 25%. Very good. Then subsequent year premium into 12.5%. Now there is a clarification in this regard. As they are not going to pay GST on the remaining part, for example, first year premium 25% means 75% premium they are not paying GST. Same way, single premium annuity 10% they are paying, means in the remaining 90% they are not paying. Should that be treated as exempted turnover for the purpose of reversal of ITC? For which CBIC clarified no. Whatever we are determining itself is the value, and that itself is the full value. So therefore there is nothing like that called exempted turnover here, which means an insurance company can take the entire ITC. So even though they are not paying GST on entire premium, is it clear or not? So see this, whether ITC to be reversed by a life insurance company on the portion of premium not included in the value as per rule 32 sub rule 4, premium value not included in the taxable value is not considered as exempted or non-taxable supply. Therefore ITC reversal shall not arise in terms of rule 42 or 43. Based on that, I have given one question, so that is connecting valuation and this ITC point. They can make one question, you can have a look into this. So question number Question number 21, page 659. HDFC Life Insurance Company Limited, a registered entity under GST, offers life insurance policies. They compute the value for payment of GST in terms of rule 32 sub rule 4 of CGST rules. In July 2024, HDFC Life Insurance received total premium of 60 lakhs from customers for various life insurance policies. 30 lakhs of this premium pertains to risk cover policy. How much should be taken as a value? How much should be taken as a value out of this 30 lakhs? 30 lakhs into, so full 100%. Why full 100%? Because it's a risk cover policy, so entire 30 lakhs will be taken. Whereas the 20 lakhs of this premium pertains to first year policies. First year policies means 25%, so which means only 5 lakhs will be taken. And 10 lakhs of this premium pertains to policies issued in earlier years. So into 12.5%, into 12.5%, which will be 1,25,000. Now you see the total of this. So 30 lakhs plus 5 lakhs plus 1,25,000, that will come to 36,25,000. So this 36,25,000 should be taken as the value, and on the GST will be payable. Now the point is, remaining 75% we are not paying. Can we consider it as exempted? No. So the company has 5 lakh of total ITC. Can they enjoy the total ITC? Yes. So you can see here 36,25,000. The rate of GST 18%. So 6,52,500 minus this entire ITC can be utilized because of the CBIC circular. As per CBIC circular, reversal of ITC shall not arise owing to reduction in value. So 5 lakhs. So net GST payable will be 1,52,500. Like that, they can blend valuation related provision to this circular. Okay. Then next one, you can see special provision for availment of ITC by a banking company, financial institution including NBFC. We all know that banking company, financial institution, NBFC, interest income will be exempted, but it will be exempted even for ITC purpose also. Whereas the other income for the bank, financial institution, NBFC, like documentation charges, processing fee, NEFT, credit card charges, etc. and all that will be taxable. So means part of their outward supply is exempted, part of their outward supply is taxable. They have two options. This is only for bank, financial institution, NBFC. What is option number 1? Proportionate ITC method, which means they will take ITC proportionate to their taxable turnover. Whereas another option is there, that is ad hoc ITC, means flat 50% of the eligible ITC they will take, remaining 50% will be lapsed. So you can see option 1, avail proportionate ITC, option 2, avail 50% of the eligible ITC. In this regard, you need to remember some key points. What is that? This option they need to select in the beginning of the financial year, and option 1 selected will remain throughout the financial year. That is normal, that you know. But another point is there. What about blocked credit? Will we take blocked credit in option 1? No. Option 2 also will not take blocked credit. And inward supply used for non-business purpose, whether we take in option 1? No. Option 2 also we will not take inward supply used for non-business purpose. Whereas inward supply used for taxable, in case of option 1 we will take full ITC, but in option 2 we will take 50% ITC. Inward supply used for exempted in option 1, we will not take ITC, but in option 2 we will take 50% ITC. Common ITC in option 1 we will take proportionate, but in case of option 2 we will take 50%, which means in option 2, inward supply exclusive used for taxable, inward supply exclusive used for exempted, inward supply used for both taxable and exempted, everything will be taken as 50%, which we are not doing in proportionate ITC. In proportionate ITC, inward supply used for taxable we are taking full, and inward supply used for exempted we are not at all taking, and common credit we are taking proportionate. That is a huge difference here. So in case of option 2, inward supply exclusive for non-business purpose and blocked credit, ITC should not be availed. 50% compute on the remaining ITC, including used exclusively for exempted supply and used exclusively for taxable supplies. And then one more difference is there, that is in case of inward supply from a distinct person. In proportionate ITC we will take proportionate ITC, but in ad hoc ITC option we will take 100%. In case of option 2, restriction of 50% shall not apply to tax paid on supplies made to another registration within the same entity, that is inward supply from a distinct person. That is no need to reverse 50% of ITC with respect to inward supply from distinct person, and this option 1's excess cannot be withdrawn during remaining part of the financial year. So this key point please keep in mind, that is inward supply exclusively for taxable we will take fully, but here we will take only 50%. Inward supply exclusively for exempted we will not take, but here we will take 50%. Okay, next. Now we are moving on to blocked credits. So blocked credits are crucial for the purpose of computation. Mostly MCQs, again in 14 marks question, this blocked credits connection will be there. At least 1 or 2 points will be tested out of this blocked credits. Blocked credits means what? Even though there are some inward supply used for business purpose, but you cannot take ITC with respect to these inward supplies. That is known as blocked credits. So blocked credits are divided into 3 parts. Number 1, motor vehicle related block credit. Number 2, that is construction related block credit. Number 3, other blocked credits. So first one, motor vehicle related block credit. Motor vehicles are divided into 3. Motor vehicle used for transportation of persons, vessels and aircrafts, and other motor vehicles. Other motor vehicles means trucks, road rollers, or cranes, or overhead this forklift trucks. All these are other motor vehicles on which definitely ITC can be availed. Even ambulance will also come under other motor vehicles. Why won't it come under transportation of persons? Because in ambulance how much money you pay also they will not transport you unless you are a patient. So it is mainly for providing the first aid. How much ever, for example 2 o'clock exam or 1:45 exam, so 1:30 it is over, can we book an ambulance? I will pay 5,000 rupees also. Not possible. So they will not transport you. So it is mainly for providing first aid during the travel. That's why it will come under other motor vehicles and ITC available. But even then they cannot enjoy the ITC. You know why they cannot enjoy the ITC? Because healthcare services including ambulance service is exempted. So due to that reason they cannot take ITC with respect to that. Then next, caravan. Caravan which is used by the celebrities or actors for the purpose of changing their dress or makeup, etc. because they will not have short-term accommodation in every place wherever they are going. For that purpose they will be buying this caravan. Can they take ITC with respect to caravan purchased? Yes. That is not for transporting persons, it will be others. So ITC can be taken. Moreover, they are registered and they are using it for business purpose. They can take ITC on that. Then motor vehicles which is used for transporting persons, if the capacity does not exceed 13, it's a block credit. If the capacity exceed 13, it's not a block credit, ITC available. What is capacity exceed 13? Stage carriage, contract carriage, that is buses and all. What is the intention behind giving this motor vehicle? If you can remember the intention, it is easy for you to remember this. That is basically motor vehicles which is used fully for business purpose they are giving, and which is partly business, partly non-business, etc. and all, like personal purpose and all they can use. That's the reason why they are restricting it. If you see, no one will go in truck, lorry for marriage functions or personal function for shopping, etc. And same way they will not take bus and all also for shopping. So it cannot be used for personal purpose, purely that can be used for business purpose. That's the reason why they are telling that these are all the cases where ITC is available. Whereas motor vehicle capacity does not exceed 13. While doing the capacity, whether we need to include driver or exclude driver, include driver. Wherever we use the word passengers, there only it will be excluding driver, otherwise it will be including driver. Capacity does not exceed 13, it's a blocked credit. However, 3 exceptions are there. Number 1, further supply. Further supply means, so I am in a car dealer. I am engaged in inward supply of cars and outward supply of cars. I can definitely take ITC because the inward supply of car is used for further supply, and supply also includes renting. I am into business of renting. Can I take ITC on the cars purchase? Yes. Cars is a motor vehicle for transporting persons. Capacity does not exceed 13. So definitely ITC is available if it is further supply. Number 2, used in the business of transportation of passengers. Example, Ola, Uber drivers can definitely take ITC with respect to the cars purchase. The driving schools also can take ITC with respect to cars purchase. So only these 3 cases, if the capacity does not exceed 13, ITC will be available. Whereas in case of vessels and aircrafts, you see, so in case of vessels and aircrafts, we have 4 exceptions. Generally, vessels and aircrafts are blocked credit. ITC not available. So these 3 exceptions are there here also. That is further supply, used in the business of transportation of passengers, driving schools, and used for transportation of goods. Used for transportation of goods is the exception where we can take ITC. For example, first flight couriers or Blue Dart courier is purchasing an aircraft for transporting the courier parcel. Can they take ITC with respect to that? Yes, they can take ITC with respect to that. And next, one more case, suppose if there is a diamond merchant who is purchasing an aeroplane for the purpose of transporting the diamonds, can he take ITC with respect to the aeroplane purchased? Yes, because used for transportation of goods means they need not be in the business of transportation of goods. Whereas in case of transportation of passengers, they should be in the business of transportation of passengers. For example, Reliance purchased aircraft for transporting its director, cannot take ITC on the aircraft purchase because it is not in the business of transportation of passengers. But Indigo Airlines or Air India purchasing an aircraft for use in the business of transportation of passengers can definitely take ITC with respect to that. And others, ITC not available. This is about motor vehicle related block credit. Now, in that, suppose if there are 4 services in relation to motor vehicles, vessels and aircrafts. So what are those 4 services? Repair and maintenance service, insurance services, and servicing, authorized service center services, hiring, renting and leasing of motor vehicles. If the motor vehicle purchase is eligible for ITC, these 4 services also eligible for ITC. If the motor vehicle purchase is not eligible for ITC, then on these 4 services also ITC not available. For example, so if there is a Ola driver who purchased a car and for that car he has taken insurance, can he take ITC on the insurance? Definitely yes, because car purchased by him, capacity does not exceed 13 and it is used in the business of transportation of passengers, therefore they can take ITC with respect to that. Okay, whereas in case where it is servicing, as a motor vehicle purchase is eligible for ITC, so even this insurance also eligible for ITC. Then a chartered accountant purchased a car for use in his profession, can he take ITC on the car purchase? No, because it is not covered under these 3 exceptions, so ITC not available. Now the chartered accountant is taking repair and maintenance in relation to car purchase, can he take ITC on repair expenditure? No, as the motor vehicle purchase is not eligible for ITC, so these 4 services also not eligible for ITC. Then you can see below, while determining the capacity, whether driver should be included or not. Yes, it should be including driver. Further supply includes purchase and sale of motor vehicles or motor vehicles used in the business of renting, hiring or leasing. I told you already, further supply need not be only sale, it can be into renting of motor vehicles also. Repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. Say for example, a person purchased a car, and with respect to that car, insurance company will give the insurance, and the car purchased, so he met with an accident. Completely the car is damaged. Now in that case, who will bear the expenditure, repair expenditure? Insurance company will bear. Can the insurance company take ITC with respect to the repair expenditure? Yes, but they don't own the car. Even though they don't own the car, definitely they can take ITC with respect to the repair expenditure. You can see that repairs, insurance and servicing of motor vehicle received by a general insurance company is always eligible for ITC. In this regard, they have added one clarification. You can see in the next page, that is whether ITC available to insurance companies on the expenses incurred for repair of motor vehicle. So they are telling, if the invoice is in the name of the insurance company, definitely on that invoice insurance company can take ITC. But if the invoice is in the name of the insured, the insurance company cannot take ITC. And moreover, here there will be something called as reimbursement mode of claim. Reimbursement mode of claim means, for example, if I am the insured, first I will make the payment to the repair, garage or workshop, etc. I will make the payment, and thereafter I will get reimbursement from the insurance company. In that case, the invoice is in the name of the insurance company. Can the insurance company take ITC? Yes, they can take ITC, but there is one point, 180 days condition. The payment has to be made within 180 days from the date of invoice. Won't the restriction be applicable to insurance company? No, because they have made payment to the insured. So due to that reason, that 180 days condition is not applicable to the insurance company. They can take ITC. That is this reimbursement mode of claim settlement. Insurance company can avail ITC even though expenses initially incurred by insured. However, invoice for repair should be in the name of the insurance company. Then next one, suppose if repair cost is beyond approved claims, say 10 lakhs is the total repair cost. In the 10 lakhs, 2 lakhs is borne by insured, 8 lakhs is borne by insurance company. Then insurance company can take ITC only to the extent of 8 lakhs. Even though full invoice is the name of the insurance company, but to whatever extent they are reimbursing, to that extent only they can take ITC. So for example, 10 lakhs into 18%, 1,80,000, but they cannot take. So 8 lakhs into 18%, to that proportion only they can take ITC. Then what if invoice is in the name of the insured? If the invoice is in the name of the insured, so insurance company cannot take ITC. Whether insured can take ITC depends upon the motor vehicle. If the motor vehicle purchased is eligible for ITC, the insurance charges paid is also eligible for ITC. This one, insurance. So if the motor vehicle is eligible for ITC, insurance is eligible for ITC. If the motor vehicle purchased is not eligible for ITC, insurance also ITC not available. So ITC not available to insurance company as conditions are not satisfied, but insured it depends upon the motor vehicle. Got it? Then related to this, I gave one question. You can have a look into this. Question number 20. ABC Insurance Limited provides general insurance services for motor vehicles. A customer, Mr. Sharma, has a policy with ABC Insurance. His car was damaged and he chose a non-network garage for repairs, including a total repair cost of 1 lakh. The insurance policy approved a claim of 80,000, which ABC Insurance later reimbursed to Mr. Sharma. Now, scenario number 1, the garage issued 2 separate invoices, one for 80,000 to ABC Insurance and another 20,000 to Mr. Sharma. What is your answer? Determine the extent of ITC available to ABC Insurance Limited in scenario 1 and explain the condition under which ITC can be claimed. What is your answer? As the invoice is in the name of insurance company, they can take ITC with respect to 80,000 only. So 80,000 only they can take ITC. Then next, scenario number 2. The garage issued a single invoice for rupees 1 lakh to ABC Insurance, but ABC Insurance only reimbursed 80,000 to Mr. Sharma, even though the invoice is for 1 lakh, but they can take ITC only to the proportionate of 80,000. Okay. Then scenario number 3, the garage issued an invoice for 1 lakh directly to Mr. Sharma, who later got reimbursed 80,000 from ABC Insurance. Now ABC Insurance cannot take ITC because the invoice is in the name of insured. Now again from the beginning, so first case, Sharma has 20,000 invoice. Can he take ITC? No, depends. He's an individual, basically he's an individual. So when he buy a motor vehicle, he cannot take ITC. As he cannot take ITC on motor vehicle purchase, so he cannot take ITC on the 20,000. Second case, the question will not arise because the invoice is not in the name of Mr. Sharma. But third case, entire 1 lakh invoice in the name of Mr. Sharma, can he take ITC? No, because the motor vehicle purchased is not eligible for ITC, so he cannot take ITC with respect to that 1 lakh also. Is it clear? Insurance company definitely cannot take ITC because invoice is not in the name of insurance company. That is the answer for these 3 questions. Explain how the provisions of section 16(2) apply to these scenarios and the implication for claiming ITC. That is, in these scenarios, the payment is not made to the garage, but the payment is made to Mr. Sharma by the insurance company. Even the insurance company is not making payment to garage, but they can take ITC wherever possible. That 180 days condition is not applicable in that case. You read the answer. Even if payment is not made by insurance limited to garage, ABC Insurance Limited to garage, they can avail ITC, and the provision of section 16(2), that is payment to supplier within 180 days condition, is not applicable in this case. So that is about this. Then one more clarification that is related to availment of ITC on demo vehicles. On demo vehicles, can they take ITC? Definitely on demo vehicles they can take ITC, because even though the demo vehicles are not for further supply, lot of two-wheeler, four-wheeler dealers, if you see, they will be purchasing the cars, and those cars they will be keeping it in their showroom for the purpose of giving a, like test drives. So in that case, can they take ITC on those test drive vehicles? So if you see the provision, so first they are purchasing car used for transporting persons, capacity does not exceed 13. So is it covered under further supply? No, it is not covered under further supply. It is not used in the business of transportation of passengers, not for driving skills, then ITC not available. But the CBIC has clarified that even though it is not in further supply, but it assists in further supply, because this particular car is used for the purpose of making the sale of other cars. Moreover, this demo car also will be sold in future when a new model is launched. When a new model of that particular vehicle is launched, so we will be selling the old model. So due to that reason, ITC should definitely be given on the demo cars. That is, ITC available on demo vehicles if they are used for promoting further supply of vehicles. And if demo vehicles are capitalized, ITC is available. Why demo vehicles are capitalized? Won't it be coming under stock in trade? No, it will not come under stock in trade. So the remaining cars will come under stock in trade. So on that depreciation we will not claim. For your information, section 32 depreciation we will not claim on stock in trade. You know that na? Super. Then only on those assets which are capitalized, which means on stock in trade we will not claim. So the question of capitalization will come only on the demo car only. So if the demo vehicle is purchased, ITC is available unless depreciation under 32 is claimed on the tax component. So unless it is claimed on tax component, so that what is it they are telling? So unless depreciation, that is if demo vehicles are capitalized, ITC is available unless depreciation under section 32 is not claimed on tax component. Sorry. So ITC is available. ITC available. Okay. Unless, sorry, correct only. No, I said correct only. So unless depreciation is computed on tax component, correct only what I said. No need to correct it. So that is, if I have added the GST component and I claim the depreciation, then I will not get ITC. That's a usual point. Also, on sale of such capitalized demo vehicles, GST is payable in terms of 18(6). So why 18(6) will come? First I am purchasing the demo car, and that demo car GST paid I have capitalized, GST paid I have taken as ITC, and it is a capital goods on which ITC availed. When we are disposing of, we need to pay GST in terms of 18(6), that ITC availed minus 5%, etc., or sale value, whichever is higher. If demo vehicles are used for non-business purpose means what? I have seen some dealers, what they will do, demo cars and all they will get, and these demo cars they will use for their personal purpose. Rather than giving it to the people for test drive, they will use it for their personal purpose. Okay, and in that case, can they take ITC with respect to that? No. But how department will know all these things? If the demo vehicles are used for non-business purpose, they cannot take ITC, they are telling, or as a part of marketing services for the manufacturer. What is this marketing service for the manufacturer? If you see big malls and all, so even Phoenix Mall, like that one mall is there in Chennai. If you have been to that mall, so completely some 6 to 7 cars are there in the ground floor. Even airport also, if you see one car, they have kept as a display. So a lot of shopping complexes or shopping malls, they are keeping the cars for display. With respect to the cars kept for display, can we use it as a trial run? Say for example, that shopping mall, one car is there. Can I take a test drive there? Give me, sir, like Beast movie, I will go on around and come. They will not give, correct or not? So therefore it is not for a test drive, and due to that reason ITC not available with respect to that car. As a part of marketing service for the manufacturer, ITC is blocked. Now related to that, I have given one question. You can see that it is question number 18. Question number 18, you can see ABC Motors, an authorized dealer for motor vehicle, purchases 5 demo vehicles from XYZ Auto Limited, a manufacturer, on October 1, 2024. These demo vehicles are used for test drives and to showcase features to potential buyers. Each vehicle has a value of 10 lakhs excluding taxes, and ABC Motors receive a tax invoice for the purchase, which includes the following: IGST on demo vehicles 1,80,000 per vehicle. So total purchase cost is 10 lakh plus 1,80,000, 11,80,000. ABC Motors plans to capitalize these vehicles in its books of accounts at rupees 10 lakh per vehicle and intends to use them for test drives for a period of 2 years before selling them as used vehicles at a written down value. After 2 years of usage, ABC Motors sells one demo vehicle for rupees 5 lakhs and IGST on the sale is applicable at 18%. Question number 1. Determine whether ABC Motors can claim input tax credit on the purchase of these demo vehicles. If yes, compute the ITC availed. As per CBIC circular, demo vehicles which are purchased and used for trials will be coming under used for further supply, because as they assist in further supply, ITC is available. So in the present case, ITC will be 1,80,000 into how many vehicles purchased? 5 vehicles purchased. So 9 lakhs will be taken as the ITC. Then 2. What will be your answer? If the motor vehicles are capitalized in its books at 11,80,000 per vehicle. If it is capitalized in books for 11,80,000 per vehicle, then in that case, ITC available or not available? Not available. ITC not available. So therefore depreciation can be claimed under section 32 of Income Tax Act on that 1,80,000 component. Calculate the GST payable at the time of sale of demo vehicles. Suppose if ITC is availed on that, how the GST will be payable? So 18 subsection 6. So please see what is the ITC availed. 1,80,000. Only one car is sold na. 1,80,000 minus what is the number of quarters for which it has been used? 8 quarters. After 2 years they are selling. Please observe the question carefully. After 2 years they are selling. 2 years means 8 quarters. So 8 into 5, 40%. So 1,80,000 minus 40%, that will be 1,08,000. Or what is the sale price at which this vehicle is sold? So that is 5 lakhs. So 5 lakhs into 18%, that will be 90,000. Whichever is higher, 1,08,000 will be taken. And can the buyer of such demo car can avail ITC? Of course, yes. They can avail ITC if eligible, because basically all these demo vehicles are purchased by travel agencies. Because for travel agencies, they don't mind whether it is a used one or new one, etc. and all. They will buy because it will be available at a very cheap rate. So they will be purchasing it, and they are in the business of transportation of passengers. So definitely they can take ITC. So buyer of such demo car, if eligible, can avail ITC with respect to this 1,08,000. Now same question, if they give, what if they have computed depreciation on the tax component? What if they have computed depreciation on the tax component? Then what is your answer when they are selling this demo vehicle? First, ITC not available, that's okay. But what will be taken as the value on which GST will be payable? You understood my question first? I am telling you, listen to the question first properly. They have purchased the demo car, 10 lakhs plus 1,80,000, 11,80,000. They purchased it, and they have capitalized the entire 11,80,000 and they claimed depreciation also under section 32. Got it? Now they are selling the demo car as usual after 2 years. Then what should be taken as the value on which GST is payable? 5 lakh? 5 lakhs into 18%. Wrong answer. Huh? WDV. Margin scheme is applicable. Notification 8 of 2018 which you have written. I made you write for this purpose only. Notification 8 2018 says whenever motor vehicles, open your book and see. So you have written value of supply while discussing rule 32 sub rule 5. There I told you notification 8 of 2018. Margin scheme is applicable. What is that margin scheme? Sale price minus depreciable value. How to compute the depreciable value? As if this is the only motor vehicle in the block, we need to compute the WDV. So, and ITC should not be availed, and here we are not availing ITC. So, you count the depreciation, and I asked you also, what is the depreciation rate like that in income tax? You said 15%, okay? So, 11,80,000 minus 15% for the first year and minus 15% for the second year, okay? But directly we cannot take na sir, because it is purchased on October 1, 2024. October 1, 2024 it is purchased means, is it put to use for more than 180 days? Yes. So we can take that full year 15%, and next year, that is next year 2025-26. So there also we can use, yes, because see here, date of purchase is October 1, 2024 to date of sale. Date of sale is October 1, 2026. So now in this case, first for 2024-25, for 24-25 you will claim 15%. Then again for 25-26 you will claim 15%. But thereafter few months are there na in 2026. For that proportionately 15%, no, that like that block of assets method and all is not there. Only 15% we need to reduce. So therefore, how much will be taken? 11,80,000 minus 15%. So minus 15%, that is 8,52,550. That will be taken as the WDV, and the sale price is 5 lakhs. Margin is negative. So GST not payable. Is it clear? Sale price minus depreciable value. Sale price will be 5 lakhs. And depreciable value will be 8,52,550. So as the sale price is less than the depreciable value, we don't have to pay any GST on that. If at all ITC has not been taken and we have capitalized at full value. Is it clear? So they can connect this with notification 8 of 2018. So if they are nut and crack and all, they will ask. Next, look into the second area, because I asked that in my mock test. Okay, in my test series, so I have framed a question like that and I have asked. So really if you want to know how the question paper could be, to what extent they can torture, just see the question papers which I have prepared for May 25 exam, so you will know. Then construction related blocked credit. Construction related block credit, that is any service, works contract service or goods. These are the three inward supply. Purchased or received in relation to construction of an immovable property. ITC available or not available on those inward supplies. ITC not available on those inward supplies. What are the three inward supplies? Any service received, any goods purchased or works contract in relation to construction of an immovable property. ITC not available. And in this case, what is the meaning of works contract? Works contract means transfer of property in goods as well as provision of services for a single consideration. But there are three exceptions where we can take ITC on these three inward supplies. Exception number 1, the restriction is only to the owner of the property. the restriction is not applicable to the supplier, that is a builder who is receiving works contract service, or a builder who is receiving any service for construction of immovable property for his client, or if the builder is purchasing any material for construction of immovable property for his client, definitely he can take ITC, but only the owner of the property cannot claim ITC. That is exception number 1. The above discussion is not applicable to supplier, that is if a works contractor receives construction service for construction of an immovable property, then ITC can be availed on construction services. Number 2, construction of plant and machinery, even though immovable, so they can take ITC provided it is a plant and machinery, but the plant and machinery excludes telecommunication towers and pipelines laid outside factory gate. For telecommunication towers or pipelines laid outside factory gate, even though it is plant and machinery, but for the definition of plant and machinery it is excluded. So due to that reason ITC not available for that. For example, construction of lifts, escalators, etc. If they receive any construction service, can they take ITC? Yes, because that is plant and machinery. Next, third exception, if the construction expenditure is charged to P&L, then also ITC cannot be availed on these inward supplies. And suppose if it is capitalized, ITC cannot be availed. If it is charged to P&L, then ITC can be availed. For example, if I am incurring some repair and renovation expenditure, that repair and renovation expenditure will definitely be charged to P&L. So can I take ITC on the construction expenditure? Yes. These are the 3 exceptions. Even though in the first exception, the builder can take ITC, but in turn that depends upon the rate of GST at which the builder will pay GST on his outward supplies. If the builder is paying GST on his outward supplies at 1.5% or 7.5%, that is real estate, residential real estate projects, they will be paying GST at 1.5 or 7.5, that is without ITC. They cannot take ITC on inward supplies. ITC not available, even though such inward supplies are not blocked ITC. Whereas if their outward supply is commercial projects, for commercial project the rate of GST is 12% or 18% with ITC, so they can take ITC. ITC available on inward supplies other than blocked credit under 17(5). In this regard, there is one amendment, that is usually telecom towers, what they will do, they will be installing these manholes and ducts for the purpose of laying down optical fiber lines. So they will dig and they will create a manhole, and inside that they will be putting one pipeline for the purpose of providing the optical fiber for all our internet, etc. and all today we are using so that broadband connections. So below the earth they are providing the optical fiber lines. For that purpose they are receiving this construction expenditure. So can they take ITC with respect to this construction expenditure for the purpose of ducts and pipelines or manholes, etc.? Yes, they can take ITC, because logically if you see, only telecommunication towers and pipelines laid outside the factory gate. First of all, it is not telecommunication towers, it is not pipeline laid outside factory gate, that is only for manufacturer, but for a telecom operator, definitely they can take ITC with respect to this. We don't have any restriction. You can see here whether ITC available on ducts and manholes used in network of optical fiber cables. Ducts and manholes which are integral part of optical fiber cables qualify as plant and machinery and can avail ITC on the same, even though used by the telecom companies, as only telecommunication towers are excluded from the meaning of plant and machinery. Even they do not fall under pipeline laid outside the factory gate. Then you can see this example related to that. Question number 22, XYZ Telecom Limited is engaged in providing telecommunication towers and is expanding its network by laying new optical fiber cables across various regions. The OFCs are housed within PVC ducts and service or connectivity manholes are installed as nodes in the network to facilitate maintenance and connectivity. The company has incurred significant expenses on purchasing these ducts and manholes. As they incurred significant expenses, definitely they will capitalize it. You are required to determine whether XYZ Telecom Limited can claim ITC on the purchase of ducts and manholes used in OFC network. So yes, as these are huge cost, they are capitalized in the books and they will fall under capital goods. Also it will come under plant and machinery other than telecommunication towers and pipeline laid outside factory. So therefore ITC available on this. Explain the rationale behind eligibility of ITC on these items referring to the relevant sections. The rationale for availment of ITC on all these things will be same. If something is not there in the block credit and it is used in the course or furtherance of business, we can definitely take ITC. So as the same is not covered under blocked ITC due to exceptions and it is used in the course or furtherance of business of telecom, they can avail ITC. Discuss whether there are any specific restrictions under 17.5 that would prevent XYZ Telecom from claiming ITC on these purchases. Yes, suppose if these parts are used for telecom towers, then they cannot take ITC with respect to that. Analyze the impact on XYZ Telecom Limited GST liability if these components were instead classified as excluded items under the definition of plant and machinery. If it is excluded from the definition of plant and machinery, then they cannot take ITC with respect to that. So that's how they can connect this particular circular. Then next, look into some special points. Only hiring, renting and leasing of motor vehicles is blocked ITC. However, leasing of any other items is not blocked ITC. For example, a company is taking immobile property on rent and on that rent they paid GST. Can they take ITC with respect to that? Yes. But immobile property constructed is blocked credit. Immobile property constructed is blocked credit, but renting is blocked credit, like that nowhere it is given. Only motor vehicles they have used the word. Hiring, renting and leasing of motor vehicle is blocked credit, that is specifically given. Hiring, renting and leasing of motor vehicles. That too, if the motor vehicle is eligible for ITC, they can take ITC with respect to hiring, renting and leasing. Then next, second point. Works contract service confined only to immobile property. So whenever we are using the word works contract service, that is only in relation to immobile property. Then ITC available on construction of pipelines inside the factory. Then ITC available on rails. So because rails are not coming under motor vehicles, so on rails. So companies will be purchasing rail. So on that rail, mainly for the purpose of manufactured goods taken to the railway station, they will lay down a pipe, like they will lay down a network, rail network, and they will also purchase the wagons for the purpose of transporting the manufactured goods by them. Definitely on rails purchase they can take ITC, and 2 or 3 wheels with capacity up to 25 cc also ITC available. Why like that? Because 2 or 3 wheels with capacity up to 25 cc will not be considered as motor vehicles, and also I have not seen any such motor vehicles which is up to 25 cc. So on basic, any motor vehicle you take, it starts with somewhere 100 cc nowadays. So less than 25 cc means a cycle which is fitted with a motor may be coming under that category. Why will that be purchased? If they purchase, they can take ITC because that is not a motor vehicle. Next, you can see other blocked credits. Other block credits, and there is one query, sir, whether ITC available for works contract service incurred and it is provided for rental. So that is one Supreme Court case here, and which is not there for exam. So don't worry. So there is one case which says that, so there is a company which is into renting of immobile property. As they are into renting safari retreats, okay, safari retreats case. If you search in Google, you will get it. Safari retreats case, and where they are into business of renting of resorts, and they have purchased, like they have received works contract services, whether they can take ITC with respect to that. So it went up to Supreme Court, and the Supreme Court is telling yes, they can take ITC with respect to that, like that. But on that, recently they have made an amendment in Finance Act to nullify that Supreme Court judgment. But this will not be applicable for your exam, so don't worry. Suppose, sir, if at all we get, what should we write? Write that ITC is available, okay? Write ITC available, because the restriction is only to the owner of the property, but here plant or machinery, so it will be coming under plant. So due to that reason, they can take ITC, like that. There is one Supreme Court case, but actually it will not be tested. Trust me, it will not be tested in exam, okay? Then, so only thing, this guy, too much he is learning GST, so that's why he has come to know. Then inward supply, look into other blocked credits. Membership of a club, health and fitness center. Membership of a club, health and fitness center is a blocked credit, even though it is for business purpose. For example, a chartered accountant takes membership of a Rotary club or a Lion club for the purpose of expanding his clientele. He cannot take ITC because it's a blocked credit. However, if it is under a statutory obligation incurred by employer to employee, they can take ITC. Example, Naval Lignite Corporation has to mandatorily take membership of a health club for the purpose of upkeep of the health of their workers. Then in that case, that membership of a club, can they take ITC? Yes, because it is under a statutory obligation. Then next, travel benefits to employees on vacation. So this employees on vacation is a blocked credit. What if the employees are going on business visit? ITC available. Again, we have an exception here if it is under a statutory obligation by employer to employee. And what if that person is not an employee? For For example, a statutory auditor is sent on a vacation by the company for which the company has incurred the travel expenditure. Can they take ITC? Yes, because statutory auditor is not an employee of the company. Then non-resident taxable person, who is NRTP, a person who is coming from outside India to India in order to provide services or supply goods in India, is known as NRTP, and they are required to get a registration, but they cannot take ITC on any inward supplies. Only on one inward supply they can take ITC, that is on import of goods. So now that IPL season has started, so now lot of foreign players will be coming to India for the purpose of playing in IPL matches. They are called as non-resident taxable persons because they don't have any physical place of business in India, and they will be engaged in supply of services, and they need to register and pay GST. And as they will be coming here and playing here, so they will be bringing their entire equipment, okay, the bat, etc. and all, they will be bringing in a cargo container. So that cargo container IGST will be paid. Can the IGST paid be taken as ITC? Yes, only that can be taken. And they will be receiving lot of inward supplies in India like hotel accommodation, food, etc. and all. Can they take ITC with respect to that? No. Then food and beverages. So food, beauty, insurance. Too much food if you eat, then health will be spoiled. So beauty treatment required, and insurance. You understood? Food, beauty, insurance. Okay. So food and beverages, outdoor catering. Beauty treatment, then cosmetic surgery, plastic surgery, hair transplantation. Then insurance. What insurance? Life insurance and health insurance. Okay. These three are blocked credits. Food, beauty, insurance. However, we have three exceptions. Exception number one, inward supply, outward supply in the same category. So I am into the business of food and beverages. I purchase food and beverages. Definitely I can take ITC because my outward supply also food and beverages, inward supply also food and beverages. Number two, exception number two, if inward supply is part or component of the composite or mixed outward supply. I am into the business of transportation of passengers, and I wanted to provide food and beverages to my passengers, and I purchase food and beverages. Definitely I can take ITC because my inward supply is part or component of the outward supply. Then third, provided by employer to employee under a statutory obligation. For example, if there is a factory which is mandatorily required to provide food to their workers who are working in the factory, for that purpose they received outdoor catering services. Can they take ITC? Yes, because it is under a statutory obligation. Then if I am purchasing from a person opting for composition scheme, I cannot take ITC. If I am purchasing any goods for personal consumption, I cannot take ITC. If I am purchasing any goods for the purpose of CSR obligation under Companies Act, I cannot take ITC. If the goods are lost, stolen, destroyed or written off or disposed of by way of gifts or free samples, ITC not available. Purchased goods lost in floods or lost in earthquake or lost in fire accident or destroyed, someone has stolen it or it has become obsolete, so I have written off, or it has been distributed as gifts or free samples, I cannot take ITC. What if that distribution of gifts or free samples constitutes supply under 7(1)(c), then definitely ITC will be available. For example, there is an employer who is purchasing a smartphone. The value of the smartphone is 80,000 rupees plus GST. Now that smartphone is given by employer as gift to the employee. As the value of the gift exceeds 50,000 rupees, it will become supply under 7(1)(c). As it becomes supply under 7(1)(c) on the smartphone purchase, they can take ITC. What if the employer gives a normal smartphone which is of some 30,000 rupees plus GST? As the value of the gift does not exceed 50,000, it is not a supply. So on that 30,000, whatever GST is paid, the employer cannot take ITC. So if the gifts or free samples constitute supply under 7(1)(c), then ITC is not required to be reversed on the inward supplies. Also, GST paid under 74, 129 or 130 or any other recovery proceedings, such GST paid cannot be availed as ITC. That is, I have not voluntarily paid GST, but through 74 it has been recovered from me, or through 130 it has been recovered from me. Now in that case, can you take ITC? First of all, when I am not voluntarily paying, why will I report it in GSTR1? So I will not report in GSTR1. Consequently, it will not come in 2B. If it is not coming in 2B, you cannot take ITC with respect to that. And moreover, if I report it in GSTR1, these sections will not come. So these sections will come only if I am not reporting in GSTR1, correct or not? So therefore, it is irrelevant. That's why they have removed it for November 25 exam. So for May 25 exam also, it will not be questioned, don't worry. Whether ITC available on goods purchased for free replacement during warranty period. So any goods which are purchased for free replacement during warranty period, so you need to understand here two aspects. Point number one, that is, you are purchasing a car and in that car purchase which is covered under a standard warranty, so there is a sensor which is not working in the car, the parking sensor is not working in the car. Now what you will do, say after 6 months of purchase of the car, as the parking sensor is not working, you will bring it to the service center, and I am the dealer, and what I need to do, I need to replace the parking sensor, and for replacement of this parking sensor I will buy the part from the market. Can I take ITC on the part purchase? Yes. Even though I am not going to charge anything to you, I am going to give it for free, I can take ITC on this part purchase. And as I take the ITC and I gave it to you, will the 71C disposal of business asset on which ITC availed will come into picture? Actually speaking, it is a business asset on which ITC is availed and it is disposed of. So definitely permanent transfer disposal of business asset on which ITC availed will come. But the circular clarified that they can take ITC. Point number 1. Point number 2, no need to treat it as supply under 71C, disposal of business asset on which ITC is availed. What if they are collecting some consideration? Of course, that consideration whatever is collected, that will become supply under 71A and they will pay GST. Then instead of purchasing the part, what if the entire product is replaced? Say for example, I am an electronic shop and you purchased one rechargeable torch, and it was working properly in my shop, and you took it to your home and you kept it for charge, and thereafter it is not working. So again you will come to my shop and get the another one as a replacement. Now that replaced one also I am buying na, can I take ITC on that? Yes. Whether it is a part or the entire product, I can definitely take ITC with respect to that. And I am giving it to you. When I am giving it to you, so will it come under 71C? Again no, it will not become supply under 71C, and don't invoke disposal of business asset on which ITC is availed. You can see here whether a part, that sensor example or entire product, so that rechargeable torch example is replaced during warranty, ITC can be availed on goods purchased for warranty irrespective of whether any consideration is charged or not with respect to such warranty repairs. Then next, where the distributor uses his stock for replacement, manufacturer replenishes the stock on which manufacturer can avail ITC. Some cases what will happen, so let's go back to that sensor example. In that sensor example, I will have in my stock some 50 sensors. So out of that 50 sensor, I will take one and I will replace. Means I am not purchasing this, and this sensor will be refilled, that is replenished by the manufacturer. For that manufacturer will buy. Can he take ITC? Yes. Even though I do the replacement under warranty, but he purchase it, he also can take ITC with respect to that. And when he is replenishing, he is sending it from his place to my place. Whether it will become supply? No, it will not become supply. Then that movement will be under the cover of a delivery challan. When distributor uses his stock for replacement, manufacturer replenishes the stock on which manufacturer can avail ITC. Then amount paid for extended warranty. So the first 2 points are related to replacement during warranty. The next 2 points they have given in relation to the additional charges collected for extended warranty. Sometimes what will happen, so usually electronic goods and all will come under a standard warranty. During that standard warranty, nothing will happen, everything will be working fine, and thereafter only the product will show its true colors. Okay, so for example, OnePlus phone and all, so suddenly one green line will come, or in Xiaomi TV and all, so TV will become green all of a sudden. Okay, so I purchased one TV, 1 year it was working, exactly warranty got over 2 weeks before. Now TV green color only. I doubted whether my eye gone or what, and thereafter, so when I am asking, sorry sir, your product is not covered under warranty, like that they are telling, you should have taken additional warranty, you replace the TV. So they are telling, so I have to lose that. So that is why lot of people will pay extra amount for that additional warranty. What is the treatment of these extra charges for additional warranty? Whether it is paid at the time of purchase from the same dealer, same time, same dealer, it is treated as a composite supply. Treated as a composite supply. It is not a composite supply. It's not a composite supply, but it is treated as a composite supply. and the rate of GST applicable to that article will be applicable to that warranty also. In case of TV, never buy the warranty like that, because the rate of GST applicable on TV will be 28% and usually warranty rate will be 18%. If you buy the warranty at the time of purchasing the TV, on that warranty they will levy 28%. Is that clear? Whereas if you buy separately at the same time, if you buy from a separate person, or if you buy from the same person at a separate time, or different person at a different time, in all other three cases, same dealer, same time, that is composite supply. Same dealer, another time, that is separate, okay, different time. Same dealer, different time. Then same time, different dealer, different time, different dealer. In all these three cases, the warranty will be treated like independent supply. If the amount paid for extended warranty after purchase of goods, then it is treated as different supply, whether purchased from the same supplier or from a different supplier. You can see one question based on this. Question number 19. Question number 19. Samsung Electronics sells a smartphone to a customer with a 1-year manufacturer warranty. During the warranty period, the customer experiences a defect and visits an authorized distributor who replaces the defective smartphone with a new one from their own stock. Samsung later replenishes the distributor stock without charging any additional amount. Additionally, at the time of purchase, a customer buys an extended 2-year warranty from a third-party service provider, Warranty Plus, which begins after the manufacturer's 1-year warranty expires. You are required to determine the GST liability for Samsung on the replacement of defective smartphone under manufacturer warranty. So dealer is replacing, and for replacing out of his stock, whether he need to reverse any ITC? No, he don't have to reverse any ITC. Moreover, whether he need to treat it as supply under 71C? No. So see the answer for the first part. As per CBSE circular, when a dealer replaces a part or whole goods, GST not payable even though it is without consideration, as GST is already paid for the defective parts or goods. Also, dealer not required to reverse any ITC. Second part of the question you see. Explain the GST implication for Samsung when it replenishes the distributor stock with a new smartphone. When he replaces with a new smartphone, what is the treatment in that case? Replenishment. Who? Manufacturer. So whether the manufacturer replenishing, can manufacturer take ITC? Yes. And manufacturer sending it to the dealer, that will not be treated as supply and that will be under the cover of a delivery challan. As per CBSE circular, when manufacturer replenishes defective goods, that is smartphone, to the dealer, GST not payable by manufacturer. Also such manufacturer not required to reverse any ITC. Third part, discuss the GST treatment for the extended warranty provided by Warranty Plus. Warranty Plus, same person or different person? Different person. Warranty Plus is different person, considering it was purchased at the time of original sale but from a different supplier. It will be treated as independent supply, and GST payable at the rate applicable to warranty, that will be 18%. If extended warranty charges is paid to different supplier at the time of purchase of product or at a later time, it is treated as separate supply and chargeable to GST at the rate applicable to extended warranty services. Analyze how the GST liability would change if the extended warranty was purchased from Samsung directly at the time of original purchase. Then it will be treated as composite supply. From the same supplier at the same time of purchase, it is a part of composite supply, and GST payable at the rate applicable to the principal supply. What is the principal supply here? That smartphone. Whatever is the rate applicable to smartphone, that will be applicable even on the warranty charges also. Then look into the next one, input tax credit in special cases, section 18. As per section 18, subsection 1, we can avail ITC on closing stock. So in 4 situations we can avail ITC on closing stock. 18(1)(a). So a person is liable to get registered and he makes application for registration within 30 days. Say for example, a person crosses his threshold limit for registration on 1st of January, and within 30 days from 1st of January he need to make application for registration. In that case, before 1st of January, that is 31st December of the previous year, whatever is the closing stock, on that closing stock GST paid can be taken as ITC. What is the meaning of closing stock? Inputs as such held in stock, inputs in the form of WIP held in stock, inputs in the form of FG held in stock, and this person at that time purchase, he was not a registered person, so therefore a matching is not required. So naturally it will not be reflecting in 2B, because at the time when he purchased, he was an unregistered person, he would not have given his GSTIN. Consequently, the supplier would not have reported it under B2B, but he would have reported it under B2C. That's why matching is not required. But which date closing stock should be taken? Immediately before the date on which he is liable to get registered. Then 18(1)(b). In case of 18(1)(b), the treatment is same, the situation alone will differ. 18(1)(b), a person voluntarily get registered. So voluntarily he is making application for registration. Now from which date he is liable to pay GST? From the date he gets registered. So therefore from the date when he get registration certificate. So which date closing stock should be taken? Before the date he get the certificate of registration, immediately before the date of registration. Here also matching not required and the entire treatment will be same. Whereas 18(1)(c), 18(1)(c) and 18(1)(d) will be applicable to a registered person. Okay. So 18(1)(c), a registered person migrated from composition scheme to normal scheme. And when a registered person is migrating from composition scheme to normal scheme, during the time when they were under composition scheme, they were not eligible to take ITC on their inward supplies. The moment when they go into normal scheme, they can take ITC on their inward supplies. So before the date of migration, so there will be some closing stock. So that closing stock, GST paid, can be taken as ITC. What is that closing stock? Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Even on capital goods also they can take ITC. But how much ITC they can take on capital goods? You can see below. On capital goods they can take GST paid minus 5% for every quarter or part thereof, from the date of purchase till the date of migration or conversion. So like usual depreciation 5% we reduce na, like that we can reduce and take ITC. Whether matching is required or not, of course matching is required, because he is a registered person. Even at the time when he was under composition scheme, he was a registered person. So therefore matching is required. Whereas which date closing stock should be taken? Immediately before the date of migration. 18(1)(d). 18(1)(d) is when a person, registered person's outward supply is exempted and it becomes taxable. Registered person's exempted supplies becomes taxable. He also can take ITC on inputs as such held in stock, inputs contained in WIP held in stock, inputs contained in FG held in stock, and even on capital goods also they can take ITC. And same ditto, everything is same for 18(1)(c), 18(1)(d). And which date closing stock should be taken? Immediately before the date of such conversion. Now what is the difference between 18(1)(a)(1)(b) versus 18(1)(c)(1)(d)? In case of 1(a)(1)(b), matching not required, 1(c)(1)(d) matching required. In case of 18(1)(a)(1)(b), 1(a)(1)(b), so whether capital goods can be taken as credit? No, but in 1(c)(1)(d) they can take credit on capital goods, and 1(a)(1)(b) is only for a unregistered person, whereas 1(c)(1)(d) will be applicable to a registered person. Okay. These are the differences. Then all these four cases, the time limit should be within 1 year prior. Means all this closing stock whatever we have discussed, this closing stock should have been purchased within 1 year prior to the date of the closing stock. The above closing stock including capital goods should have been purchased within 1 year prior, and that is the invoice date to the closing stock date should be 1 year. And ITC with respect to GST paid on inputs and inputs, like inputs can be availed as ITC, but for capital goods only we need to reduce. For inputs don't reduce. Full whatever GST paid we can take as ITC, but capital goods we need to reduce 5%. And how to take this ITC? In 3B? No, not in 3B. We need to file an electronic declaration. What is that electronic declaration? ITC 1. It should be filed within 30 days from the date on which you are eligible. In case of 18(1)(a), when are you eligible? Whenever you get the registration certificate. 1B also whenever you get the registration certificate. 1C whenever you are migrating from composition scheme to normal scheme. 1D whenever your exempted supplies becomes taxable. From the date within 30 days we need to file this ITC 1, and it can be for a extended period, further extended period by commissioner. And this particular declaration, that is ITC 1, should be certified by a CACMA if the claim of ITC exceeds 2 lakhs. If the claim of ITC does not exceed 2 lakhs, self declaration. If the claim of ITC exceeds 2 lakhs, CACMA certificate. Similar provision we have in refunds also. If the refund amount does not exceed 2 lakhs, self-declaration. If the refund amount exceeds 2 lakhs, CACMA certification. Same logic. Then transfer of ITC, section 18(3). Whenever I am transferring the business with specific provision for transfer of liabilities, so then in that case, remember the transfer of business should be with transfer of liabilities, means all assets and liabilities should be transferred. Then in that case, whatever is the unutilized ITC in the electronic credit ledger of the transferor will be transferred to the electronic credit ledger of the transferee. So that will be transferred, but remember it should be with specific provision for transfer of liabilities. What is the form that is required for the purpose of transfer of this ITC? ITC2. Whether that ITC2 should be certified by CACMA always it should be certified by CACMA that this business is transferred with the specific provision for transfer of liabilities. Then remember, in case of merger there won't be any problem. For example, A Limited and B Limited is getting merged into A Limited and B Limited is getting merged into AB Limited. Then in that case, A Limited also can transfer ITC, B Limited also can transfer ITC to AB Limited. Now, say for example, AB Limited is getting demerged into A Limited and B Limited. Then in that case, whatever ITC that is there with the AB Limited will be transferred to A Limited and B Limited in what ratio? In the assets ratio. So A Limited and B Limited assets ratio we need to see as on the date of demerger. In that assets ratio the ITC will be transferred. So in case of demerger, credit shall be transferred to the new entities in the ratio of net assets. What is the meaning of net assets? Net assets means total assets minus ITC. Total assets minus ITC. We are transferring ITC only. For that purpose only we need to get. So all assets minus ITC. That is the meaning of this net assets. All assets, total assets minus ITC, that should be taken. And whether ITC is availed or not on that assets, we need to take all the assets. For example, land is also will be there in the assets, building also will be there in the assets, but on land and building we will not take ITC now. So therefore all assets should be taken. And which date the assets should be? As on the date of demerger. As on the date of demerger we need to see the assets ratio. Don't see thereafter, because thereafter individually they might also have purchased the assets. So that should not be taken as the criteria. So we need to see the assets ratio only as on the date of demerger. Then next, in case of transfer or change in ownership of business will include transfer or change in ownership due to death of sole proprietor. Say there is a sole proprietor who is dead and his son has taken over the business. Then in that case, so when the son is taking over the business, he need to get a new registration, because permanent account number is connected to GSTIN. So whenever the person changes, so definitely GSTIN also should change. So the son should get a new registration even though he continues the business, and from father's registration to son registration, ITC can be transferred. In that case, the son only will file ITC 1 in the name of the father, ITC 2 in the name of the father, and the ITC gets transferred. That is this. Then transferor and transferee should be in the same state. For example, I am having a e-commerce business. That e-commerce business is like, and I am from Tamil Nadu. E-commerce business, there is no place of business. It is a website or it is an app. Anywhere to anywhere it can be transferred. So transferor Tamil Nadu, transferee is in Maharashtra. I am transferring this e-commerce business to transferee in Maharashtra. The transfer of business is possible, but the ITC cannot be transferred. So the transferee should also be in the same state. So transferor is in Tamil Nadu. So transferee should also be in Tamil Nadu. Then only the ITC can be transferred. That is this. Then when a single registration is getting converted into multiple registration. So far within the state, I am having single registration for 4 places of business. Now I want to go for separate registration. From single registration, whatever ITC is there, that will go to all the 4 registrations in what ratio? Just like demerger, in the assets ratio. In this case, the form will be ITC 2A, and ITC 2A need not be certified by CRCMA. When a single registration gets converted to multiple registrations within the state, then also ITC against the single registration can be distributed to multiple registrations by filing ITC 2A. Assets ratio as on the date of registration should be considered for this purpose. And you can see some special points in this regard. ITC 2 to be certified by CACMA irrespective of the amount of ITC. But ITC 2A is not required to be certified by CACMA. And in case of demerger, balance in ITC as on the date of transfer, very very important. For example, demerger has taken place in July 2024. Demerger has taken place in July 2024, and ITC transfer ITC transfer, they are doing it somewhere in October 2024. Okay. Now, we need to take the assets as on which date? We need to see the assets ratio as on which date? So, July 2024, you see assets ratio. You see the assets ratio as on July 2024. But ITC balance as on which date should be seen? July 2024 or October 2024? October 2024. ITC balance you need to see as on October 2024. See there, in case of demerger, balance in ITC as on the date of transfer. When the date of transfer? October 2024. And the ratio of assets on the date of demerger. What is the date of demerger? July 2024. Got it? Understood? This point also can be tested in MCQ. Then next we have 18 subsection 4 read with 29 subsection 5, that is reversal of ITC on closing stock. This reversal of ITC on closing stock is opposite of 18.1D and 18.1C. 18.1C is what? Composition scheme to normal scheme. Now reverse, normal scheme to composition scheme. 18.1D, exempted supplies to taxable. Now opposite, taxable supplies to exempted supplies. One more case also, section 29 subsection 5, cancellation of registration. In all these three cases, we will reverse the ITC on closing stock. There we avail the ITC on closing stock. Here we will reverse the ITC on closing stock. What is the ITC on closing stock? Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock. Whatever ITC we have availed, that much we need to reverse. Whereas capital goods also we need to reverse. How much credit we need to reverse with respect to capital goods? ITC availed on that capital goods, and the life of the capital goods should be taken as 60 months, and see the balance life of the capital goods. To that extent we need to do the reverse. So ITC availed divided by 60 months into balance life. This much is the ITC we need to reverse. Now concentrate. There is one question one student has asked me in the morning, that is, sir, I am reversing this ITC. Will I have to pay this literally? No. You have some balance in ITC. See, whenever you are migrating into composition scheme, you were under normal scheme, means some ITC balance will be there. And whenever you are going into, like exempted supplies, so far you were under taxable, means some balance will be there. When your registration is getting cancelled, also some balance you are having. Say, like this you need to reverse 1,50,000. But the balance that you have in your ITC is 1 lakh. Then what you will do? 1,50,000, you will adjust from 1 lakh. Remaining 50,000 you will pay out of your pocket. Is it clear or not? Suppose if the 1,50,000 needs to be reversed, but you have a balance of 1,75,000. So from 1,75,000, this 1,50,000 will be adjusted. So balance 25,000 will be lapsed. Okay, that is the meaning of this. So inputs and capital goods can be purchased any time. While availing the ITC on closing stock, they brought in a time limit of 1 year. Means within 1 year prior it should have been purchased, because availing ITC is lost to government. So that's why 1 year time limit. While reversing the ITC, even if you purchase 3 years before or 4 years before, also reverse. It's okay, reverse. So because reversal of ITC is gain to them, na, so no time limit, you reverse. Inputs and capital goods can be purchased any time on which ITC availed. If ITC not availed, then you don't have to reverse. On such inputs and capital goods, then reversal shall not arise. If capital goods are purchased before 5 years, then already the life has been over. Na. Original the ITC availed divided by 60 months into balance life. Beyond 5 years means 5 years means 5 into 12, 60 months over. So therefore there won't be anything to be reversed. Then what if invoice is missing, and in case of 18.1C1D matching is required, correct? So matching is required, then only we can take ITC. But in this 18 subsection 4, no matching. If you have the asset, you reverse. If you have the asset, that is if you have the closing stock, if you have the capital goods, you need to reverse. Sir, I don't know the invoice. You don't know invoice. Today whatever is the market value you take and you reverse. Okay. If invoice pertaining to such inputs is not available, then market value you need to take. Sir, I don't know market value. Go to CA/CMA, they will tell. Can be considered and practicing CR/CMA required to certify in that case. What is the form in which we need to submit reversal of ITC? ITC 3. ITC 1 for availment of ITC on closing stock, ITC 2 transfer of ITC in case of transfer of business, ITC 2A single registration getting separated into multiple registration, ITC 3 reversal of ITC on closing stock. If there is any balance in ITC after reversal, that shall be lapsed. If there is any shortfall for reversal, then such shortfall shall be payable using cash ledger, and we need to do this computation separately for CGST, SGST and IGST. Then next one, GST payable under 18(6), already we know how to compute, but in this there is one special point, that is if there are refractory bricks. Refractory bricks are used for the purpose of construction of commercial kilns where we heat the raw material, that refractory bricks, molds and dies, jigs and fixtures. If these three are sold as scrap, don't compare ARB whichever is higher, just take the sale value of this scrap into GST rate. So generally for capital goods on which ITC avail, we need to take ARB whichever is highest, but in this case of refractory bricks, molds and dies, jigs and fixtures sold as scrap, then normal GST payable on sale value. Then next, section 19 read with section 143 of CGST Act. This is related to job work provisions. So in case of job work, what will happen? So there will be a principal manufacturer and who is a registered person. He is purchasing some inputs and capital goods. Just look into the chart, that is sufficient. So there is a principal manufacturer who is purchasing some inputs and capital goods, and at the time of purchase of these inputs and capital goods, the principal will take the ITC with respect to that, and the principal manufacturer is sending the inputs and capital goods for job work to the job worker. When he is sending the inputs and capital goods to the job work, whether the principal manufacturer is required to reverse any ITC? No, they are not required to reverse any ITC, and they will be just sending it to the job worker. And what is the implication on job worker? So job worker, when they receive it, they need to convert into processed goods, and within 1 year they need to send back the processed goods. What is the time limit? 1 year, and this 1 year can be extended for a further period of 1 year, and it will be returned to the principal. In case of capital goods, what is the time period within which it should be returned to the principal? 3 years, and it can be extended for a further period of 2 years. So processed goods 1 year plus 1 year, capital goods 3 years plus 2 years. If the job worker is not returning within 1 year plus 1 year or 3 years plus 2 years, what will happen? Then it will be deemed as supplied by principal to the job worker. On which date? On the date it is dispatched to job worker. If inputs and capital goods not received within the time limit, deemed as supply under section 19, on which day? On the date of dispatch to the job worker. It is like after that 1 year or after that 3 years or after the time limit. So the principal will come to know that the supply has happened long back. It is like, so CA final exam you are going to write. Now you got to admit card for intermediate. So it is like that. So over, time is over, and they are telling now you should have paid. How much torturous it will be? So means last 1 year, last 2 years, I need to pay the interest. You understood? Mainly for the sake of interest, they created this provision that for the last 1 year, 2 years, I need to pay interest. How much, sir? 18%. Whose father's money? I don't know whose father's money. And that has to be paid on the date of dispatch to job worker. If the goods are directly received from the principal of the supplier of the principal, sometimes what will happen? The principal will not be dispatching it to the job worker. There will be one supplier. There will be one supplier to this principal. From supplier place directly the job worker will receive. Then from the date of receipt of job worker, we need to count that 1 year or 3 years as the case may be. And on the date of receipt by job worker, it is deemed as supply. Say this. If the goods are directly received from the supplier of principal, then the date of receipt by job worker is deemed to be the date of supply. Then this principal should report all these details of goods sent on job work and received from job work in one form. What is that form? ITC 4. And this ITC 4 should be filed on a yearly basis if the aggregate turnover during previous year does not exceed 5 crores. Annually by 25th April of next financial year. If the aggregate turnover during the previous year exceeds 5 crores, half yearly by 25th of the month following every half year. For example, so April to September by 25th of October, October to March by 25th of April. So mainly this is useful for MCQs and theory purpose only. Okay, you need to remember this time limit, and you also should remember what will happen if the goods are not received within the time limit, and you need to remember the time limit for ITC 4. Then look into the next one, some special points in this regard. Such goods should be sent to job work under the cover of a delivery challan and e-way bill, because it is not a supply, and e-way bill always required irrespective of the value. Two cases I told you, handicrafts and goods sent on job work, always e-way bill is required. Even if the goods are directly received by the job worker, ITC can be availed by principal. Why? Bill to ship to. When the goods are received by job worker, it is deemed that the principal has received the goods, and the principal can take ITC with respect to that. Now, for doing this process, job worker will purchase some goods. Can the job worker take ITC with respect to those goods? Yes. Job worker can avail ITC on the inputs and input services used for job work. If the processed goods or capital goods are returned by the job worker after 1 year or 3 years. Now see what happened, as the goods are not returned within 1 year or 3 years, so principal is treating it as supply and he will pay GST along with interest. Now after 1 year or 3 years, as the case may be, the job worker will return. At that time it is treated as a new sale made by the job worker. Again job worker should pay GST on that. Okay, so they were smoking something writing this provision. So if processed goods or capital goods are returned by job worker after 1 year or 3 years, it is treated as new supply by job worker and chargeable to GST, which can be availed as ITC by principal. If job worker is not registered, the principal should declare the job worker's place as additional place of business of principal. Why? Because the goods, taxable goods are in that place. So that's why principal should show job worker's place as principal's additional place of business. And jurisdictional officer must be intimated about the job work contract. Processed goods may be brought back to principal's place or can be sold directly from job worker's place. That is what. So goods need not be brought back. Even if the goods are directly sold from job worker's place also, it is deemed that the goods are received back within 1 year or 3 years. And this time limit of 3 years and 2 years is there na capital goods. That is not applicable in case of molds and dies, jigs and fixtures and tools. Okay, so here we have molds and dies, jigs and fixtures, refractory bricks. In the place of refractory bricks they have added tools. Then ISD section 20 and section 21. Who is an input service distributor? Input service distributor is a head office which will receive the inward supplies for input services. Remember, only input services. It is not input distributor. It is not capital goods distributor. It is input service distributor. The head office can take ITC only with respect to input services and distribute the credit to the branch offices. And in what ratio they need to distribute the credit. If the inward supply is attributable only to one division, the entire credit will be distributed to that division. If the inward supply is attributable to more than one division, it will be distributed to all the divisions in their turnover ratio, not assets ratio, turnover ratio. Okay, say this. There is a ISD, input service distributor, and they need to get a separate registration, and they need to receive tax invoices for input services, and this ITC they will take and distribute it to their divisions under the same permanent account number. Distribution of ITC of CGST, SGST, UTGST, ISD, IGST by issuing a ISD invoice. I told you this ISD invoice is also one of the tax paid document for the purpose of availment of ITC. And very important point is that, say if the ISD is located somewhere in Tamil Nadu, that is head office is in Tamil Nadu, and there is a branch office which is also located in Tamil Nadu, then in that case CGST distribute as CGST, SGST as SGST, IGST as IGST. Suppose if the branch is located in Karnataka or the branch is located in Maharashtra, then in that case what they will do? So they will distribute CGST, SGST, IGST, everything as IGST only. Okay, so therefore to Tamil Nadu CGST, then SGST, then IGST, it will be distributed like this. Whereas to Karnataka and to Maharashtra, it will be distributed only as IGST. That point I have given below, you can see. CGST and SGST distribute as CGST, SGST for unit in the same state of ISD, and distributed as IGST if the unit is in the different state than that of ISD. And suppose if the input service is attributable only to one unit, then the ITC is distributed to that unit entirely. If the input service is attributable to two or more units, then the ITC is distributed to such two or more units in the turnover ratio. If the input service is attributable to all units, then ITC, that is common, like advertisement services, statutory audit services or marketing services, etc., then it's a common service. It will be distributed to all units which are operational based on turnover ratio. Which turnover should be taken? Either you take the turnover of previous year or you take the turnover of the last quarter based on the availability. Then ITC to be distributed on a monthly basis and return to be filed in GSTR 6. So ISD is required to file a return in GSTR 6 by 13th of the month following every month, and that data will be reflected in 2B, 2A, 2B of the divisions. Okay. So then excess distributed ITC can be recovered by issuing a ISD credit note. Sometimes what will happen, by mistake they would have distributed excess credit. To reduce that credit, they need to give a ISD credit note. To whichever division they have given less, they will be giving ISD debit note or invoice. Shortfall in distribution can be distributed using ISD invoice. Distributed credit should not exceed the credit available for distribution. For example, if 1 lakh is ITC, 1 lakh only should be distributed. If they distribute extra, that is an offence. Penalty will come. ISD default. Hope you remember. Next, if the ISD has distributed excess credit to any recipient, the excess can be recovered from the recipient with interest, not from the head office. They are telling they are going to recover from the recipient along with interest. ISD should obtain compulsory registration irrespective of their aggregate turnover. And this is one point which I told you, that is while computing turnover under rule 42, rule 43, and here also we have come across turnover, we should not take old indirect taxes. What are the 4 old indirect taxes? Central excise duty, state excise duty, CST and VAT. And there is one circular. This circular is applicable only for May 25 exam. Thereafter the circular will not be applicable. ISD or cross charge, because with effect from 1st April 2025 they have made ISD mandatory. So means everyone should go for ISD only. Up to that 31st March 2025 they have given either they can follow input service distributor or the cross charge. Cross charge means what? That is one branch or one division will receive the invoice. There is no concept of ISD. One branch or one division or one head office will receive the invoice and in turn raise the invoices to the other branches. For example, we have say 3 branches, branch 1, branch 2, branch 3, and a chartered accountant raised invoice for audit services to branch 1. Now what branch 1 will do? Will in turn raise invoice to branch 2 and branch 3 and will enjoy the ITC. This is called as cross charge. So previously what they used to do, chartered accountant will be raising invoice to corporate office, from corporate office they used to get the credit. But now like this, what is the advantage of this? The advantage is that they don't have to follow turnover ratio. They don't have to follow the turnover ratio. Directly to whatever extent branch 2 and branch 3 is having liabilities, to that extent they can transfer this. That is the advantage in cross charge, and that advantage only they have removed now. So CBIC circular on ISD cross charge, either ISD or cross charge can be followed by head office for distribution of credit to branch office. In case of cross charge, normal invoice raised by head office to branch office normally, and turnover ratio need not be followed. But very important point is that these services should be attributable to the branch office. That is there. Means it should be common services. It should not be attributable to one division only. It should be common services that they can distribute by way of cross charge. And with effect from 1/4/2025, ISD is mandatory and cross charge cannot be followed. With this we completed input tax credit. In input tax credit, so that warranty I discussed, that was actually one old provision. Now whatever I have discussed with you is recently added. Previously also we had some provisions, but that provision to this provision, what is the difference, sir? Simple. In previously only a part was given, now entire product replaced also they have added. Previously, so about 7(1)(c) they were silent. So ITC can be availed, that was there previously also, but 7(1)(c) can be invoked or cannot be invoked, so that was silent at that time. Now they clarified that you should not invoke 7(1)(c), because what department started doing, they were telling, okay pa, you take the ITC, but you pay GST on that, like that they were telling, sir, why should we pay GST? Because it is disposal of business asset on which ITC avail. So that's why they gave a clarification stating that it is not a supply, so they don't invoke 7(1)(c). Then one more point about manufacturer sending the replenishment of the stock, there was no clarity at that time, so it was required to raise invoice and e-way bill, and invoice and e-way bill means unnecessarily they need to pay GST on that. Now that is also clarified, and they are telling due to replenishment of the stock, just delivery challan is sufficient, they don't have to raise any invoice, and e-way bill of course is required, but it is delivery challan, it will not be treated as supply. Then another dispute was there, can the manufacturer take ITC on their purchases? Replacement is done by dealer. Can the manufacturer take ITC on their purchases? That clarity was also not there. Now they have given that clarity also. Yes, manufacturer can definitely take ITC even though the replacement is done by the dealer or distributor, etc. The next one is with respect to that additional charges. Additional charges, there was no clarity about, if it is from the same dealer or different dealer, same time or different time, like that. For that also now they gave a clarity. Same dealer, same time only composite supply. All other cases individual supply. Okay. So I have fun or what to tell you that this is an amendment. Really it is an amendment pa. So it was there because one student asked me, sir, already it was old amendment only. Why are you telling it as a new amendment? Trust me pa, mother promise pa. It is an amendment only. So that is about this.